economic surprises have really plunged over the last couple of weeks and are now in negative territory.
The momentum in inflation in the last 3-4 months has just been moving in the wrong direction.
The tighter policy is faster should be the fall in inflation. So what the Fed is doing is undershooting here.
We don't see any data to indicate that they're suddenly going to have to cut by 4 or 5 times by the end of the year.
We're going to wake up one day and realize, whoa, things aren't as good as we thought they were.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Here it is, looking for a pivot point in inflation. Good morning. Welcome back. This is a Bloomberg Surveillance on Bloomberg Television. Annmarie Hordern and Lisa Abramowicz. John Ferro will be back tomorrow saying good morning. Good morning. I promise he is off today. However, today we are so lucky to have Brian Levitt of Invesco with us for the hour, our favorite FOMO kind of guy who's been absolutely right at a time when everyone's been looking for signs of greater disinflation starting about with data about 2.5 hours from now. Good morning. We are looking at markets that are doing pretty much nothing. They did pretty much nothing yesterday as well. Brian, are you still a FOMO kind of guy?
I am still a FOMO kind of guy. And, the reality is we're in this environment right now where everybody's talking about the Fed. They're so concerned when the Fed's going to move and by how much. The reality, Lisa, is markets historically have done very well with the Fed on hold and the economy reasonably strong. So we're still in a good nominal growth backdrop. I know everyone's going to be staring at that 10th place on every inflation point that comes out. I still think we're in an environment where inflation's going to moderate and ultimately these markets are likely to press higher.
At a time when we are at the twilight of the earnings season and people are very much looking to tomorrow when we do get retail sales to get a sense of the latest read, we are getting Home Depot earnings coming out a bit disappointing with comparable sales down 2.8% versus an estimate of 2.2%. We'll parse into all the details. So far, has the read through been generally, Brian, that we do see a weakening consumer, but still strong enough to power optimism and FOMO types of feelings?
Yeah, we do see a little bit of a weakening consumer. You've seen that a little bit in the latest consumer sentiment number as well. But we have to remember that's what the Fed was trying to accomplish. We can't have it both ways. So we had this robust consumer that had everybody concerned. The Federal Reserve has raised interest rates. Things are moderating. We can't now look at the other side and say, oh, the consumer's falling off a cliff. I mean, we knew the consumer wasn't going to continue to spend at the same clip, but the reality is we've got a very low unemployment rate. Leading indicators for the job market continue to look fine. And so that's supportive for the consumer. It's not the same excess savings that we had a couple of years ago. The government's not coming back with $6 trillion, but it's a consumer that has a job and continues to feel good about their situation.
We're talking about a couple different prongs to the hour. We're going to be talking about inflation data coming out at 8:30 a.m. today and then 8:30 a.m. tomorrow. We're going to be talking about earnings as they come out. And, of course, we have to talk about the policy backdrop at Annmarie. We did see, as expected, earlier this morning, the Biden administration came out and did announce those tariffs on certain Chinese goods, targeted tariffs. Did we learn anything new from the actual announcement this morning?
Well, we have the top line number now. So the changes in the impact of these new tariffs, and it's across a wide scope of imports, semiconductors, batteries, solar cells, critical minerals, $18 billion in current imports. I think what's interesting about this, one, the administration's been talking about this literally for years when they took the review of the Trump-era tariffs on board with the 301, but also they've signposted this. And this really has to come now at a time where we're less than 6 months out from the election, and both Biden and the former president are jockeying for votes and talking tough on China. That remains very key and top of mind to American voters.
So we're going to be discussing this throughout the hour in terms of how you really plan around this and invest around things that some people say could be inflationary, could dampen growth. Right now, just to get a state of play of what's going on in markets, basically flat yesterday, pretty much on par for the same today, hovering around that 52.47 mark. You could see yields just around, again, 4.47 on the 10-year, on the 2-year. You can see a similar type of stasis. Crude slightly down, but this is a market that really really is on hold as we wait for some sort of sign of a catalyst of whether we're heading toward that immaculate disinflation, or maybe not immaculate, but at least a soft landing versus stagflation. Brian Levitt, who is with us for the hour, I want to ask you about the latest Bank of America fund manager survey, which came out and showed investor optimism at some of the strongest levels that we've seen going back to 2021, even as investors are expecting a deterioration in earnings and a deterioration in the economic growth trajectory. Is this entirely dependent on the Fed cutting?
Well, it's not entirely dependent on the Fed cutting. As I had already said, if you look at years like 06, you look at years like 2019, or even now, market can do very well with the Fed on hold. So the good nominal growth environment has been supportive. I do suspect, like the Bank of America survey says, that things will slow. And you think about slowdown, we'll see if the Fed feels comfortable cutting within that. I think they would like to. But I think what investors are looking to is over the next few years, we're going to be normalizing the yield curve. And if you can normalize the yield curve without having had a meaningful disruption in economic activity, that should be a positive. I've said over and over that peak inflation, peak tightening, peak interest rates over the next few years should be good for equities. And I continue to stand by that.
Which is the reason why in this fund manager survey, Annmarie, we did see this optimism of several rate cuts this year, even with a deterioration in backdrop because of this promise of potentially peak yields. Michael Hartnett over at Bank of America did raise the specter of stagflation, which is something that Jay Powell has shrugged off, laughed off. There is no stag, there is no inflation. This is the biggest headwind right now that a lot of people say to equities.
A lot of people are saying it's to equities. David Malpass, former head of the World Bank, this is his whole thesis into what we're actually seeing in some of the data he's looking at. But I look to the Global Fund Manager Survey sentiment not as close eyes and sell levels, but risk assets are vulnerable to more evidence of stagflation. Brian, do you see any evidence of stagflation?
I like the way Lisa put it. And I was going to say, I don't see stag and I don't see inflation.
Well, that's Jay Powell.
Exactly.
So let's start with inflation. If you look in the bond market, whether it's the 3-year break even, the 5-year break even, the bond market's expectation for inflation, they're all very stable, very much within the Fed's comfort zone. Now, with regards to stag, it's certainly not a stag economy. Are things going to slow? Well, yeah, that's ultimately what we wanted to have happen. As things slow, inflationary pressures should moderate. You're already starting to see it. When everybody talks about the momentum of inflation over the last few months, hasn't been too much on the consumer side. Very critically, it hasn't been wages. Wages have been generally benign. It's been a lot of import inflation. And what are you starting to see already with commodity prices? What are you starting to see with oil? Kind of moving down. And so I think that what ends up happening when we get to these pivot points, and Lisa, you started the show with that pivot point, people, for whatever reason, think of the worst environment that they can imagine.
Catastrophic thinking.
Yeah, it's
They're
like
watching Lisa.
It's genetic. Carry on.
Well, she just said pivot. She didn't say catastrophic. All of a sudden, it's going to be the 1970s again, and yet this is a very different environment. If you look at the misery index, which is the unemployment rate plus inflation, it's historically quite low. Right, that doesn't suggest stagflation. Now, could it move? Yeah, but what direction is inflation going? I don't think it's heading higher here.
Part of the problem that a lot of people are looking at, including Philip Jefferson yesterday of the Fed when he was speaking, is we just have seen this persistency to inflation. Yeah. And what we have seen is an actual acceleration, a reacceleration in the first quarter inflation data versus the last quarter of last year. This could be year-over-year comps, but you take a look yesterday of the New York Fed Consumer Sentiment Survey and inflation expectations, and you could see they are creeping higher. And it's not just broad-based, but also for home prices, which were supposed to be the most affected by keeping rates where they are. So at a certain point, you have to look at that and say, hold on a second. We can dismiss this as going to be disinflation, but we expected that pivot point last year. We expected that pivot point 6 months ago. If you ignore what the data is actually showing, that will be another error.
Correct, although the question is, when we see things ticking up a little, they're off of low levels. Some of it's being driven, or relatively low levels. Some of it's being driven by commodities, and some of it's likely being driven, if you look in the Consumer Price Index report, by some of the lagged effects of shelter. Housing and rents had come down over a year ago, particularly rents. I mean, I don't know which one we want to look at, but if we believe the Zillow numbers or others, those rent numbers should be down by now. So it's not being captured necessarily in the Consumer Price Index. Fed's preferred measure of inflation below 3%. That's the core personal consumption expenditure. As I mentioned earlier, the tips break evens relatively benign. So I think I wonder if the consumer, when they're being asked, are they thinking about the high cost of living, which is now part of our life, or are they thinking about the change and the change in the rate of change? It's kind of like everything I learned I needed to know in kindergarten, everything I learned I needed to learn in calculus class. So ultimately, this is going to, in my opinion, it's going to moderate. We'll look back and say, remember, we were worried that the economy was too strong, the consumer was too strong, it was all inflationary. Then we'll be in a slowdown, and the market will, do a 10% decline in a slowdown, and we'll be saying, gee, I really miss those strong nominal growth days.
The thing is, though, and when Lisa brings up the New York Fed one-year inflation expectations, the survey, the bank said that respondents project inflation a year from now at 3.3%. That's much higher than where we are today. How much does that inflationary concern on top of consumers' minds change how they're potentially going to go out and spend the remainder of the year?
Well, you're starting to see, if you look at the Michigan survey, the consumer is starting to say that these prices are becoming, somewhat problematic. And so remember, the recent move, we've had a move in oil prices, we've had a move in gasoline prices. Those are starting to moderate, at least on the oil side, starting to moderate here. And so remember, we started this by saying, can the consumer hang in? Right? And the consumer's saying things are likely to slow here a bit. You saw it in the Home Depot numbers. And so we shouldn't be, well, on this side, the sentiment says inflation's going to keep going, but the numbers are showing that they're moderating. Again, from our perspective, if we look at the consumer momentum, pretty benign, wages pretty benign. A lot of it has been this import price inflation that now seems to be moderating.
You mentioned Home Depot. Let's just give you a rerun of that. If you are just joining us, they did report earnings. Comparable sales coming in light, down 2.8% versus the estimate of 2.2%. You could see customer transactions were down about expected, about 1%. The key here and why you're not seeing a bigger move really is that they still keep all of their 2025 year forecasts. The comparable sales about still down 1%. Sales still increasing by about 1%. Earnings per share growth about 1%. So this really does seem to point to stability, as we heard from Brian. Here is also this idea that, yes, there is a softness due to people maybe not moving, they have already done a lot of the home improvement, but there is this sense that people still have money to spend. If there is one takeaway, Brian, from this earnings season, what would you say it is?
It's a mixed picture, but I would say the biggest takeaway is that everybody thought we'd be in a recession by 2023, and we're still growing earnings 10% in the quarter. And so it's still a good nominal growth backdrop. And everybody's worried whether inflation's 2.8, 3%, 3.3. Remember, businesses make money in nominal terms. And so a good nominal growth environment is supportive for corporate profitability. And what I say to investors, if they were so worried we'd be in a deep economic downturn by now, the reality is things still are good and companies are still benefiting. It's mixed, right? We're seeing more from tech, we're seeing more from financials than perhaps energy or some other parts of the market. But again, another good earnings period.
All of this being said, next we're going to talk about the policy implications and how that factors into all of this. Brian Levitt, you're going to be staying with us for the hour. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with our own Danny Berger. Danny.
Hey, Lisa, French President Emmanuel Macron says he would be open to a takeover of a major French bank, even by a non-French bank, as long as they're in the EU. Macron said deeper financial integration is critical for the bloc's future prosperity.
Dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
This is a totally new world, and we do need this new business model for the Europeans. More innovation, more investment, single market and capital market union, and a relevant trade policy.
Macron there was speaking exclusively to Bloomberg at the annual Choose France summit. There he said that the EU needs a fresh approach to business. Let's just recap some of the breaking news on tariffs we got about an hour ago. President Biden imposing new tariffs. We've been waiting for this on Chinese chips, minerals, and EVs. It's an election year bid to boost domestic manufacturing. The White House says the move will affect about $18 billion in imports. It is the most comprehensive update to tariffs on China, which were first imposed by former President Donald Trump. The changes will take effect between 2024 and 26. Chevron's bid to buy Hess has hit a snag. Investors are being urged to abstain for voting for the deal. It comes as a shareholder advisor cited concerns about valuation and a dispute involving Exxon over an oil project in Guyana. It's yet another blow to what would be Chevron's biggest deal in 2 decades. The transaction still needs a green light from the FTC, and it's expected to drag on for at least until the end of this year. That's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, Goldman Sachs' David Solomon saying the U.S. needs a sharper focus on debt.
We're long out of that pandemic, and the spending levels, are continuing at a pace that I think is raising our debt level and creating issues for us down the road. So I think this is something that deserves a lot of attention. It's not getting as much attention as I'd like to see it get right now.
Oi, the deficit. That's next. This is Surveillance. Welcome back on a day where everyone is looking to 8:30 a.m. for the beginning of a key inflation data dump that we get throughout the week. Right now, we're seeing basically absolute stasis in markets, because why would anyone have a conviction trade at a time where it seems like people are on tenterhooks waiting for the next narrative pivot? We are seeing a bit of action, though, with yields lower once again, 447 on the 10-year. Under surveillance this morning, Goldman Sachs' David Solomon saying the U.S. needs a sharper focus on debt. Here's the latest. The U.S. facing a debt crisis, at least some say so, with the budget deficit more than 6% of GDP last year and unemployment below 4%.
The level of debt in the United States, the level of spending is something that we need a sharper focus on and more dialogue around than what we've seen. We obviously had a pandemic. We made a bunch of decisions, in that pandemic, but we're long out of that pandemic, and the spending levels, are continuing at a pace that I think is raising our debt level and creating issues for us down the road. So I think this is something that deserves a lot of attention. It's not getting as much attention as I'd like to see it get right now. We're obviously in an election year, so I'm not, I don't have my head in the sand. I don't think you're going to see that get a lot of attention prior to the election, but I do think it's something that requires focus. We need to deal with the debt and the deficits, and, hopefully there'll be a lot more discussion as we come through the election and move into the next administration.
Well, let's give it a bit of time now if we can. I often say that the United States has a privilege of behaving recklessly sometimes that maybe the likes of the Europeans do not. Have you sensed there's been any kind of pushback from the Treasury market, from investors, against the backdrop and this risk that we're talking about currently? Well,
the reserve currency is a great privilege. I'm not going to sit here and say that I see in the near term, a threat to that in any way, shape, or form. But it's not something that you can take for granted. And the United States' ability to spend without constraint is not unlimited. Ultimately, the market will challenge that. Hasn't challenged it yet. I'm not saying that's something that's coming soon, but it's certainly something that we should be very cognizant of and very protective of.
Do you think the experience of the UK a couple of years back was maybe a case study for what we could face in America?
Well, that was a disruption to the gilt market, and it's one of the things I think you need to be concerned about. It's a risk issue I've highlighted before. At the time, the Bank of England had to reverse its course and become very accommodative to deal with that blip in the markets. We've had disruptions in the Treasury market before. We certainly had a disruption in March 2020. To the degree that we had a significant disruption in the Treasury market sometime in the future, we don't have a lot of capacity through the banking system to intermediate that. It would require very accommodative policy. If that came at a time where that was not right for the central bank to be accommodative, that would be a risk issue that would have to be monitored. We're definitely not falling off a cliff. I think the U.S. economy is chugging along pretty well. I think the market is set up for pretty much what you see now is what you'll get throughout the rest of 2024. There have been a bunch of data points that indicate a slowing in what I'd call the bottom 25 or 30% of the consumer economy, where people are making different choices and starting to tighten up on some of their spending choices. You've seen some earnings reports in the last few weeks that indicate that. But broadly speaking, the service sector is still relatively strong, and I think the economy is still in pretty good shape. You know, where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
That was David Solomon of Goldman Sachs sitting down with our own Jonathan Ferro in Versailles. Watch the whole interview on YouTube, on Bloomberg.com if you missed it. Brian Levitt still with us of Invesco. And, you know, we're hearing a lot about the deficit. And before we get to some of the other policy prescriptions, are you in the oi the deficit camp, as Steve Eisman said?
I am not in the oi the deficit or the oi the debt camp. And it's interesting, Lisa, it's the number one question that I get from individual investors. It's as if people believe they're going to wake up one morning and there's going to be a debt crisis in this country that resembles an Argentina or a Turkey. That's not how this is going to move. And here are the things that I like to talk to investors about. The first thing is, we did spend a lot of money in order to respond to two crises, and we got out of those two crises without disaster or depression, right? So let's be happy we live in a country that can do that. The second is, the U.S. is a very wealthy country, so people throw around the 35 trillion number, which is large. I've read that you can stack dollar bills from here to the planet Uranus and you're not at 35 trillion. It's a large number. But what's the total household net worth in this country? It's $150 trillion. Right? So household net worth in this country is 5x the debt level. Very wealthy country. And the third point is, we have a very captive audience for U.S. debt. There's not going to be a moment of comeuppance where the federal government isn't going to be investing in it. The U.S. financial institutions aren't going to be investing in it. My father, who loves 4.5%, isn't going to be investing in it, right? And even the foreign investors, remember, China's only 2%. Japan, the Brits, Germans, those are all ally countries.
If you're worried about the deficit, no, Mr. Levitt's on the other side of you, and he's got your back. I am curious, Brian, just on a broader level, we have been hearing about all of the tariffs that might come down the pike. They did come down the pike today. Annmarie was mentioning that. How much do you take this into account, not necessarily with electric vehicles, but more broadly in terms of areas that you won't invest in, or notes of caution around international companies that might face headwinds in places like China?
Well, my view is that tariffs will lead to less optimal economic outcomes, right? We've all learned in our courses about comparative advantages, and you want production taking place where countries or regions have the comparative advantage. So if you don't do that, there's less optimal outcomes. But from the market perspective, the market will price it in fairly quickly, right? So the markets will adjust on a valuation basis to take into account the tariffs. What the market needs is clarity. And so if you think about 2018 was a 20% down year in the markets. The Fed was raising rates, but I would argue it was largely because of the uncertainty of the trade war that hit business investment. And once we got clarity, regardless of what the terms of it was, by 2019, we had a much better year for markets. So again, less optimal outcomes, market will price for it quickly. Clarity, in my opinion, is what's most important.
Treasury Secretary Janet Yellen said yesterday to me when I sat down with her in Virginia that potentially China would respond to this. This morning, the Treasury's out with a statement, and she ends with it saying that she looks forward to continuing to advance U.S. interests on behalf of the administration's behalf, to have a responsible management of this economic relationship. But seeing these kind of tariffs and the walls going up, depending on who's in the White House, it's going to get more fractious when it comes to the U.S. and Beijing. How does an investor you deal with that?
Yeah, and that's probably the one thing that our policymakers agree on, right? From both of our candidates agree that we want to be more America first or tougher on China. You know, the point I was making, Elisa, is that the markets do tend to respond to it pretty quickly. So it creates value opportunities for investors. Now, if you're a U.S. investor considering Chinese assets, what you recognize is that valuations have been cheaper for a while. This supports that. What you're looking for in China is things were weak. Are they improving? Are we getting surprises to the upside? And is policy going to be supportive? And I think both of those answers are yes.
Especially with the latest bond sale. Brian Levitt, you're going to be sticking with us. Coming up, we'll go live to the Qatar Economic Forum for a conversation with Jenny Johnson of Franklin Templeton. Welcome back. This is Bloomberg Surveillance on the key inflation day and the data dump that we're going to get this week, starting with PPI in about 2 hours' time. Markets more about not doing much, although still up about 5% on the S&P going back to the third week of April as we look to a potential Fed that is going to be cutting rates. If you look at what's going on in the bond market, you could see yields just basically hovering around that same level. You can see 483 on the 2-year, 447 on the 10-year. For exchange, somnolent as well, as people try to get a sense of whether this is going to be the exceptional U.S. or whether we're basically moving toward a different kind of environment. Before we get to other stories, wanted just to have a quick beat. Brian Levitt with us of Invesco. How much are you watching the whole GameStop craze in terms of GameStop and AMC and the return of Roaring Kitty?
The return of Roaring Kitty. Well, that's certainly interesting, but what I worry about it is that it gives investors the perception that all of this is manipulated or none of it is real. And the reality is when you look at the broad market, corporate earnings have been moving up as well with the market. So there's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression. Look, I think maybe we'll get a dumb money sequel to the movie, something I can watch on my next flight. But it's entertaining, but I don't put a lot of emphasis on it.
That's the reason why a lot of people are dismissing it and saying that it's not necessarily going to be similar to what we saw back in 2021. Under surveillance this morning, Secretary of State Antony Blinken is in Ukraine, looking to assure leadership of the country's defense against Russia. The visit and meeting with Ukraine's president comes as U.S. aid was held up in Congress for months. Weapons and aid from the $60 billion approved by Congress in April are now making their way to the battlefield at a time, Annmarie, where you're seeing some rejiggering of leadership, particularly in the defense sector in Russia. What is the latest in terms of progress in this conflict?
Well, this is an urgent time for Ukraine. You see the Russians are coming in and making a massive offensive into Kharkiv, which probably the biggest we've seen since this war began. It also comes at a time that Zelensky is once again saying we need that support from the United States. Remember, the money that they just signed up for is delayed. They were talking about this kind of money to support the U.S. industrial base, to send more of those weapons to Ukraine in the fall of last year. We are now in the summer. So Zelensky this morning saying Ukraine needs 2 air defense batteries just for Kharkiv. Also interesting, Blinken touching down in Kyiv. This morning we find out in a few days' time, Putin will be going over to China. It is so important how China has been really helping Russia in terms of being able to continue to sell their oil and gas and some of the other ways they are really putting their thumb on the scale and helping Putin conduct this war.
Which brings us to our next story, which is President Biden announcing sweeping tariffs on Chinese chips, minerals, and electric vehicles. The White House saying the move will affect about $18 billion in imports. This marks the most comprehensive update to tariffs on China, which were first imposed by former President Donald Trump. None of those were rolled back, as some people had originally expected. Just to connect the two stories, it seems like the rivalries between the U.S. and China keep amping up. This is widely expected. Is there anything new in this? You talk about the headline number, but new in this that gives an indication of what Biden's trajectory will be going forward with respect to this relationship?
Well, the trajectory looks like they're prepared for a little bit more of that tit for tat when it comes to Beijing. Recently, what we saw, one response Beijing had was on a chemical import that the U.S. has an export into China. They put a tariff on it. China potentially can respond to this. That is something the Treasury Secretary alluded to me yesterday. But I think what this shows is that whether or not it's Biden or Trump next year, the walls are going up when it comes to China. And at the same time, if you're the U.S. administration, you're trying to get Beijing to potentially lessen that thumb on the scale when it comes to helping Putin. they're not in a position that they're going to want to do that at this moment if they see actually there's going to be more of this disengagement with the United States.
Meanwhile, on the economic front, the consumer in focus and inflation data and retail sales coming out this week. Jonathan Ferro yesterday sat down with Bank of America CEO Brian Moynihan, who is optimistic on the state of the consumer despite higher rates for shoppers and borrowers. Take a listen.
But I think our team thinks that the terminal rate, the end rate that they'll get to will be more in the 3.5% range as opposed to 50 basis point range or 1% range. And we haven't really had that since before the financial crisis. There was a moment in 16, 17, 18 where they raised rates and they already started bringing them down to 19. So frankly, in our team, I say, if you're under 40, you've never seen this kind of rate environment. And this is normal. And so 3% front end, 3.5%, 4.5% 10-year, and people will get used to it because America did a lot of economic activity prior to 2007 for the 200-plus years of existence. So people have been used to it. It's just that we're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We're hearing from some companies that maybe there are some cracks. We heard from Starbucks, McDonald's offering a similar view on the U.S. consumer. You've got some 69 million customers. What do you see? Do you see those cracks at all starting to emerge this year?
So if you think about it, where would the cracks emerge? You talked about the average account balances. They're still, especially for households 75, 100,000 and below, the account balances are higher than the pandemic by a lot. If you think about the spending settled into a more normal, where it was in 16, 17, 18, the Fed was raising rates, inflation, they're pushing, inflation was higher, they're pushing it down or holding it steady. So that's normal. And then on the credit side, we're just normalizing to where we were in 19. So in 2019 was a 50-year low in credit costs in our company, and basically last quarter we were a little bit higher than that. And so we're normalizing, so it's increasing off a base. And people say, oh, your charge-offs are going up, but they're getting back to where they were in 19, and frankly, people thought that was very good credit, and it factually was. And so the question is where they go next. The good news is we're starting to see delinquencies flatten back out, i.e. they're not growing anymore. They normalize, and then they're staying. That's good news on the consumer side, so it's all okay.
That was Brian Moynihan speaking to our own Jonathan Ferro. Of course, the FICO scores on average of a Bank of America client are higher. So there is this question of how bifurcated this is. A host of financial and economic thinkers are meeting right now in Doha for the annual Qatar Economic Forum. Bloomberg's Haslinda Amin is sitting down with Franklin Templeton CEO Jenny Johnson. Let's head over to Haslinda. Haslinda, thank you for joining us. Please take it away.
Well, that's right. Of course, it is an area, a region which Jenny is really interested in. Jenny, lots of money is sloshing around in this part of the world, especially with the sovereign wealth funds. But there's also a lot of competition. How do you nail those deals eventually, ultimately, you think?
Well, actually, Franklin Templeton's been in this region for over 25 years, so we know it well. We acquired in 2007 a local asset management company, so now we're one of the biggest GCC bond managers. We're one of the largest multinational Sharia managers. So, we're really steeped in the culture and the business here, and 4 of the top 10 sovereign wealth funds are here. So then it's about what do you have that they're interested in? And with the alternative capabilities that we've built out, fortunately, that's been an area of great interest.
How does the region fit into your longer and bigger strategy as you navigate the company from active to passive?
Well, we're very much focused on active management. So we're fans of active management. Where passive has done well is on the equity side. Fixed income is still pretty active, and obviously the alternatives not. So, again, we have clients in 160 countries. So our job is to have capabilities that work for any of our clients. And as these sovereign wealth funds, which often think very multi-generational, so they're real long-term investors, we see that our private market capabilities has actually been probably more at the forefront of their interest. But then in the central banks here, they tend to be much more conservative. So the traditional fixed income capabilities and equity capabilities are, areas of interest for the central banks.
The thing is, when you take a look at sovereign wealth funds, for instance, there's growing interest in private credit, in alternative assets. Is there a sense that perhaps you might have to do acquisitions in this part of the world to meet the needs and the interests, growing appetite?
Well, fortunately for us, we did do an acquisition in 2007. It's traditional fixed income, but actually we had a client, a sovereign wealth fund, saying they were interested in Sharia private credit. We were able to have our local team reach out to our private credit team and say, why don't we work together and deliver this? We'll do this Sharia screen and you manage the private credit. So, we think of all the different investment capabilities as we have as ingredients, and we can build customized solutions for clients.
Jenny, I also want to talk about China, because not too long ago when we spoke, you talked about how there's been so much pessimism priced into the Chinese market. We're seeing some improvement. How are you assessing the potential there?
Yeah, I mean, I think there's been a lot of pain, obviously, in the Chinese market, and you've seen it with where the equity markets went. Again, it's the second largest economy in the world. They've been very focused on growing their domestic economy, and that therefore creates opportunities. We've had a joint venture in China for over 20 years with local investment people on the ground. When you're in a local market, you can understand where there's growth and where there isn't growth, and that creates investment opportunities. And I think the thing that we've seen with China is when the government of China wants to do something, and they have indicated that it's important that they have a robust market, they can provide the kind of incentives and catalysts to do that. So, we think China has gone through a lot of pain, but there's still opportunity in segments of China.
Have you seen the worst in Chinese property market?
So the Chinese property market's interesting. Again, where there's pain, there can be opportunity. I was talking to somebody who says the wealth channel in China, that families who have lost money in the property market are realizing they need to have a diversified portfolio. So they're just starting to diversify out of some of their real estate into other parts. Again, as a manager with investment teams on the ground, that's a great opportunity for us.
Of course, we're all keeping an eye on that U.S. election. If we have a Trump 2.0, Jenny, would it change all the assumptions you're making right now about investing in China? Because we saw how the Trump administration caused a lot of pain. We saw how the yuan slumped during his administration.
What I think that potentially could be underestimated is the entrepreneur's ability to figure out how to navigate these kind of environments. And in speaking to folks in Hong Kong and who handle supply chains and others, there are a lot of mid-sized companies in China who have figured out that they can set up their last stage of manufacturing in Vietnam and Indonesia, Malaysia, and just assemble enough to meet, say, the WTO requirements, and then it's stamped made in Vietnam, for example, and then it gets imported into the U.S. and bypasses those tariffs. So, look, there's no question that there's a shifting of supply chain that's going on that naturally has to happen. But I don't think it kills the Chinese economies. I don't think a Trump administration necessarily is going to.
You talk about the shifting of supply chains, and a lot of the countries in this part of the world, in Asia, have benefited as a result. Are you seeing attractive markets right now that were not considered before?
Well, certainly, in Asia, a lot of those smaller markets that I just mentioned are getting the benefit of this China plus one supply chain story. I think, obviously in this region, with the price of oil where it is, and I don't think anybody sees a quick ending to Russia-Ukraine, so chances are oil stays high. There's a real desire to diversify the economies here and make investments in technology, AI, renewable energy. All those they're looking for partners, so all those become an opportunity to make investments.
Jenny, thank you so much for your time.
Thank you.
Jenny Johnson, Franklin Templeton CEO, and Lisa, handing it back to you. We're coming to you live from the Qatar Economic Forum.
Thank you so much. That's Bloomberg's Haslinda Amin at the Qatar Economic Forum with Franklin Templeton CEO Jenny Johnson. Thank you so much. Great work as always. Right now, let's get to an update and stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Let's get a check on Home Depot shares. Down by about 1/3%. It reported a 6th consecutive quarter of negative sales. Yet another retailer flagging some softness in the consumer. This time, it's one that has been holding off on renovations and instead prioritizing essentials. The CEO, Ted Decker, says that Home Depot was hit by continued softness in certain larger discretionary projects and a delayed start to spring. Now, speaking of retailers, the next big box earnings we're going to get is Walmart on Thursday. In the meantime, Bloomberg has learned that Walmart is set to cut hundreds of corporate jobs. It has also asked most of its remote workers to return to the office. Employees, if they're in a smaller U.S. office, are being asked to go to the bigger hubs. That includes their Arkansas headquarters. And the meme stocks, they are roaring back. Traders once again piling into shares like GameStop and AMC. GameStop yesterday surging more than 74%. It's up almost another 50%, 59% in the pre-market trade. All that was needed for this rally was just one tweet from Keith Gill yesterday, also known as Roaring Kitty. The post on X, it had no words. It was literally just a picture of a man sitting up with a gaming controller. Gill hasn't been active online for years, so it was seen by some as a call to action, and a call to action they got. That's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, commodities in focus.
And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago.
It depends on where you look in the commodity sector, but certainly in some of the precious metals. That's coming up next. You're watching Bloomberg Surveillance. All eyes headed toward less than 2 hours ahead to that key PPI data, the beginning of an inflation data dump. We are seeing markets searching for direction. Very much front and focus has been the commodity sector, as Peter Scheer was mentioning over the past couple of months. Under surveillance this morning, very much whether we see inflation in commodities.
And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago. And as you look through the data, I don't want to say stagflation. I don't think that's a realistic situation, but I can't dismiss it as easily now as I could a month ago.
Here's the latest. Oil steadying. WTI hovering around $79 a barrel as traders await OPEC's next move and inflation data. Meanwhile, on the other side, copper touching its highest level since 2022, fueled by forecasts of a global supply deficit. Jeff Curry of Carlisle joining us now. And Jeff, that's where I want to start. Traditionally, people focused on oil prices. Right now, what we're seeing is oil steadying, but we're seeing the rest of the commodity complex surging ahead, up some 8.2% since the end of February. What makes for the divergence?
Copper is the new oil. We put out a piece back in 2021, making these bullish arguments. And by the way, they haven't worked out. But I talk to a lot of people who will say copper is their highest conviction trade. I wear my copper bracelet right here. It is the highest conviction trade I've ever seen. If you've got decarbonization, green CapEx demand, AI, data center demand, military demand, it takes 12, sometimes 26 years to bring on new supply. You can't come up with a better story. But the bottom line, we've been telling this story for 3 years, and maybe now it's beginning to work. I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have three sources of demand this time around, meaning green CapEx, AI, plus military. Back in 2021, all we had was the green CapEx demand, and now it's in full force. Supply's not there. Inventories are tight.
Prices have more than doubled going back to March of 2020, and I'm looking right now. How far more is there to rally at a time where you're still wearing your copper bracelet?
I think, our target was $15,000 a ton when it's trading, just a little bit above 10,000 as of this morning, which means, it's got a long ways to go. Where do we come up with that 15,000? It was the highest real price ever reached in 1968 during that housing boom. So we don't know where demand destruction occurs. All we do know is that bringing on new supply is very difficult. So we're going to learn where those price levels are, where you begin to kick out demand. But I go back to the 2000s, and as bullish on oil then as I am copper today. Oil ended up going up from 20 to 147 times. So, the upside on copper here, I think, is very significant.
We're seeing a lot of supply when it comes to countries outside of OPEC plus, Jeff. Do you think that potentially we're on a bearish trajectory when it comes to the oil market for this year and next?
Absolutely not. One of the big sources of oil supply over the last 18 months came from sanctioned countries. Venezuela, Iran, Russia. Yes, they've attacked these sanctions and clamped down, but they don't come into effect until after the election 180 days from now. So that's been one of the big drivers. And also in energy, don't forget the massive surge in coal production that occurred in China, Indonesia, and India over that same time period. So there's a lot of energy in the system that has backed up that needs to be eaten through. When we think about the underlying demand, it's not spectacular like it is in copper, but it's rock solid. It's well above long-term average growth rates. You're going into the gasoline driving season, jet fuel, and by the way, remember, global warming means your cooling season is going to create more demand in the past. We didn't build inventory, so that 3Q bull story is still very much intact, driven by fundamentals, even without any geopolitical risk priced in. Also on oil, I want to note that when we look at positioning, it's down to the 14th percentile. Now, this market is basically no long positioning in it right now. And we're still sitting at $83, $84 a barrel, which is a testament to the underlying strength. Putting it all together, I want to emphasize commodities are still the best performing asset class despite the pullback in oil prices.
Jeff, let's talk about gold for a moment. I'm not wearing any gold that I can hold up, but it's a time where investors can get real yields in short-term parts of the market. Why are gold prices still going up, and how much of that is activity by the central bankers?
Well, I think a big difference between this commodity rally and any other commodity rally most any human being alive has ever seen before is it's not accompanied with dollar recycling. Meaning, think about, the petrodollar system. Oil prices go up, Saudi Arabia accumulates more dollars, they plow it into U.S. treasuries, puts downward pressure on rates, dollar begins to weaken, which reinforces the reflation, and it becomes a virtuous cycle between oil prices and the dollar, reinforcing higher commodity prices. That's not playing out this time. Why? Because many of the BRICS countries back in November of last year decided to start to trade with one another using local currencies and then settle the differences in gold. So what we've replaced dollar recycling with is gold recycling. And that has created this uptick in gold despite a stronger dollar. Normally, you would look at the fundamentals today and you would go, oh, gold should be going down. Real rates are higher, dollar is stronger. Those are all the dynamics that put downward pressure on gold. Instead, gold's going up. What's driving it is that strong demand coming out of these emerging markets where they're now recycling into gold as opposed to U.S. Treasuries, creating that dollar recycling theme. So this still has more legs to it. We see more upside in gold prices from here.
I guess, Jeff, what we're trying to get at is there are some stories that people have been bandying about all year, whether it's the EV transition or some of the grid build out that's going to require more copper usage, whether it's some of the central banks shifting more to gold. Why do they have so much further to go if it's a lot being priced in and speculators coming in and trying to get ahead of them and bidding it up even further? What gives you a sense that there could be a catalyst for another leg higher in the near term?
Because you need to destroy demand. Right now, you're running on fumes of very low inventories, particularly of copper. You have no way to bring on new supply. Once you're out, when prices began to spike, they got to spike high enough to bring demand back in line with supply. That's where we're going to find out where that elasticity of demand really exists. The only one we can ever observe is going back to the 1960s, which suggests maybe it's 15,000, but we really don't know. We're going to find out. We didn't find out in the 2000s bull market because China was never forced into a situation where it had to consume and you had to ration demand out. That's why we peaked out in that $10,000 a ton range, similar to where we are right now. So going forward, no inventory. Remember, really strong demand from all those sources you talked about. There's not enough to go around. Somebody's going to have to drop out, and that's where we're going to find out where the high print is on this market.
Jeff, if I could just go back to your answer earlier on the oil market, and you see this very bullish market happening, and you see potentially we're not even at peak driving season. If we do see gasoline prices in the United States go past $4 a gallon, are you expecting the U.S. to tap the SPR?
Yeah, but there's a lot of other levers they can pull to put downward pressure on oil prices. That's why I'm far more bullish on base metals, copper, than I am on oil, particularly until you get after the election. Because when you look at what drives elections, what drives the populist focus, it is the economy and inflation. So keeping oil prices and gasoline prices under wraps over the course of the next 6 months, I think is going to be critical to the administration and the government. And we've seen this play out election after election. So I can't see why this one would be any different. What does that limit, on oil? It means you can get up into the high 90s. Maybe, you could top over 100 or something like that in the midst of the cooling season. But, would it be lasting? No, it's not like the underlying copper story, where it doesn't really impact the underlying inflation. Now, you throw in something like some surprise problem in the Middle East or something like that, that could open up the upside. But I think, you're going to see governments around the world doing everything they can to fight this. And one of the ways is, turning a blind eye to, sanctioned oil, sanctioned products. So there's a lot of methods other than tapping the SPR that can be used to, also relaxing environmental regulations. We've seen them use that in the past as well. So there's lots of tools at their disposal.
Jeff Carey of Carlisle, thank you so much. Keep wearing that, copper bracelet until you hit 15,000 or bust. Thank you so much. Brian Levitt of Invesco, thank you so much for waking up early and joining us here on set. Coming up next, Emily Rowland of John Hancock Investment Management, Joe Feldman of Telsey Advisory Group, and former NEC Director Gary Cohn. This is Bloomberg.
Consumer is in a weaker situation today than a year ago.
Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again.
The upward pressure on inflation is just really strong over the next several months.
We've all been asking for the last year and a half, when does the consumer slow down? I think we're seeing some of that.
In the end, when it comes to the fate of the economy, it's not about the consumer. It's about whether companies make money.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Is this still the pivot party as we wait for that disinflation? From New York City, for our audience worldwide, good morning. This is Bloomberg Surveillance. Annmarie Hordern. I'm Lisa Abramowicz. Jonathan Ferro will be back in his seat tomorrow saying good morning, good morning. Right now, we're looking at a market that's looking for direction at a time we're awaiting a couple of very important data dumps, including PPI that comes out in about 90 minutes time. How important, Annmarie, are some of the data that we're going to be getting, and it's heading into CPI and retail sales tomorrow, to really determine whether we've reached this pivot point for inflation into a more directly downward trend?
And then, of course, the PCE, which is what the Fed looks at. And we're going to be hearing as well from Jay Powell today. So potentially he'll be able to talk about the data from the PPI. What we're seeing in the Bank of America survey today is that wagers on interest rate cuts have sent investor optimism to this 2.5-year high. People are still expecting at least one for the second half of this year, Lisa.
And how much is that really driving things? And that's the reason why when we spoke to Emily Rowland a couple of months ago, she said, this is a pivot party. Join the pivot party. We're going to be speaking with Emily Rowland in just a bit and really ask her that question. Is that essentially what's upholding some of the investor optimism, which is the greatest going back to some 2021 at a time where earnings are coming in a bit light? We saw that from Home Depot this morning.
And also we're going to get Walmart, which I think is going to be key to, on top of the retail sales numbers, on how strong this consumer actually is. And what are you potentially seeing in terms of the inflation story? Look at the ISM. When you look what the businesses are saying, they still say that they see inflationary pressures in their pipeline.
Which is a reason why we saw that New York Fed survey come out yesterday, kind of reiterating what we saw in the University of Michigan sentiment survey on Friday. People seeing that 1 year out, that 3-year forecast of inflation creeping higher at a time where housing prices are expected to go up. Other goods, we're talking about copper and Jeff Curry's copper bracelet. There is that sort of inflation aspect of the day. There's also the policy aspect of every single conversation you have with any investor, especially at a time where tariffs are coming out. We did finally get those tariffs from the Biden administration. Annmarie, we talked about how, not really surprising, this has been highly telegraphed. Headline number came in as far as what we're expecting. Did we hear about how this was going to be implemented and what's to come next?
Well, the headline number, $18 billion. But we're talking about inflation. Tariffs are inflationary, but it does seem like this is specific to certain sectors. It's going after those certain sectors that this administration has also been focused on from their own industrial policy. And you look at the likes of EVs, 25 or 27.5% tariffs on a Chinese EV coming to the United States. There's not a single Chinese EV in the United States right now. Well, they're boosting that to 100% in terms of that tariff. But okay, that sounds like a big deal, but what difference does it make? It's not tangible. So I think what a lot of these tariffs show, and this is what Terry Haynes said to us yesterday in Washington, D.C., is it's symbolic of where the direction of travel is when it comes to Beijing and Washington.
And how much this is going to be inflationary is something people are definitely trying to parse through, and which areas stand to benefit in the United States. Right now, markets kind of searching, again, as we said, for direction. Yesterday, not much action. Today, neither, although not exactly a negative kind of read at a time where we are getting the last gasp of earnings and ahead of the inflation data. In the yield space, very much front and focus for me. Again, not a lot of action, 447 on the 10-year, but the path of travel is really important to look at. We're down from a high of 470 on April 25th. It really just, again, reiterating this question of how much has the Fed underpinned optimism, both at the corporate level as well as the investor level, with the idea that they do want to cut rates in the near future. Coming up, Emily Rowland weighing in on that of John Hancock as traders await that U.S. PPI data. Joe Feldman of Telsey reacting to Home Depot's disappointing results, and former National Economic Council Director Gary Cohn as the U.S. imposes fresh tariffs on China. Let's begin with our top story, stocks on pause ahead of U.S. PPI data. Emily Rowland of John Hancock writing this: if the streak of softer economic data persists, markets may be priced for too much optimism on the earnings front. Emily joining us now. And Emily, I want to start with the pivot party that you talked about. You were heralding that pivot party, talking about how things were getting out of control. Are we still kind of seeing that, or in some ways a resurgence of that, with this idea that investors are confident that Jay Powell wants to cut rates?
Yeah, Lisa, we're still in the pivot party, I would say. And Chair Powell's been the lead bartender on this. You know, starting last fall, just the idea that rate cuts were coming spurred this risk-on rally that was picked up by momentum investors. And he just has not deviated from that dovish message. So as much as you loosen financial conditions, then you're seeing, again, this party taking place. I would say the one thing that's maybe causing people to go home are these whiffs of stagflation that we keep seeing. So it's little things like in the Michigan sentiment survey that you just mentioned, seeing inflation expectations picking up. Some of the business surveys we look at are suggesting that demand is slowing at the same time where prices paid is moving higher. It's tough to say we're in stagflation right now. Atlanta Fed GDP estimates for this quarter over 4%. We're looking at unemployment less than 4%. Core PCE, which of course is the Fed's preferred measure of inflation, has been coming in around 2.8% year over year for the last several months. But markets are starting to trade like we're in stagflation. We're seeing areas like defensive equities and value stocks catching up to tech and communication services. That's where the best earnings have been. But we're seeing this rotation starting to play out as stagflation becomes a bigger theme.
Are you following that? Or do you kind of push back and say, we are seeing 4% GDP growth? Things aren't stagflating. This is just an issue of things slowing exactly by design by the Fed policy.
Yeah. Well, we're still looking at this through the lens of factors. So in this environment, we still like quality stocks, ones with great balance sheets, tons of cash. You want to own that in an environment where maybe we are higher for longer. We don't want to own companies that have high interest burdens. The challenge is a lot of people like quality stocks. So they've run up a lot. They are overbought in our view. We still like it. They've got the best fundamentals. I mean, just look at earnings season. Tech, comm services driving the bulk of it up 20 to 30%. Without the Mag 7, S&P 500 earnings have actually come in at negative 2% year over year. That's the fifth consecutive quarter of negative growth. So we want to own those companies, but we've got to diversify away from that, owning some stuff that's cheap. And you're finding that on the value and the defensive side. We like utilities. We like areas like healthcare that are really helping balance the valuation risk that we're seeing in quality.
When you look at potential evidence of stagflation, the market is trading as though we're in it, but you're pointing to key economic indicators that say we're not. So how do you see this story playing out?
Yeah, I think eventually what we'll see happen is rates are going to chop around here as we're kind of oscillating between growth concerns and inflation concerns. As long as you see inflation continuing to moderate, you see growth slowing, and we can do it at this kind of very moderate level, I think stocks are going to celebrate that. You're going to see yields come down. I mean, Lisa mentioned, we haven't talked much about this. We just saw the 10-year Treasury yield drop about 25 basis points in 2 weeks. That is an environment that's favorable for equities for now. But if we start to see a more precipitous decline, say initial claims spike again, that was a big spike last week to 231,000. Maybe there were some statistical anomalies in the data. we'll have to see. But if yields start to fall more precipitously, to us, that's going to signal that, yes, there's relief on the inflation front, but something's not going that well on the growth front. So we've got to be mindful of that. In that environment, of course, you want to lean into bonds and take a little bit of risk off the table.
Are markets priced for too much optimism when it comes to earnings?
Well, the challenge, Annmarie, is not this earnings season. It was pretty good. Earnings came in around 5%. The challenge is going forward from here. So when we look at what analysts on the street are penciling in for Q2, it's 10%. For Q3, 8%. For Q4, a whopping 17%. So if we continue to see a moderation or a softness playing out in the economic data, that probably means that there's a bit too much optimism baked into earnings. Now, of course, you can find opportunities underneath the hood, but it's going to be really, really important to really follow those stories and find those companies that can generate the best earnings from here.
Emily, it's been a whirlwind for the surveillance crew. We've been in Washington, D.C. yesterday. John's over in Paris, talking to different people. Yesterday in D.C., very much front and focus was the deficit, the federal deficit, how much to worry about it. I'm not going to ask you about that. I'm more interested actually in where the money is going. You're welcome. Where the money is going in terms of why this spending has been going on in such a robust way. How much are you following the money, the fiscal expenditures that are going to companies that still have yet to be spent, particularly in the chip sector, particularly in some of the industrial complex?
It's a great question because right or wrong, it's happening. And we're actually increasing the size of the deficit with the unemployment rate below 4%. This is pretty wild. There's not much precedent for this, but right or wrong, again, we want to follow the money. It's going to things like the Infrastructure and Jobs Act and the CHIPS Act. We're seeing a manufacturing renaissance taking place in the United States. Industrial production's booming in the U.S. Midwest. So we're looking to capitalize on that by investing in areas like mid-cap stocks, which have a large overweight to industrials companies that are directly involved in this manufacturing boom that's being helped by onshoring initiatives as well, with supply chains coming back from China and other parts of the world. So that's really the sweet spot. And guess what? You're not overpaying for it. U.S. mid-cap value stocks, they're on sale to the most significant level since the late 1990s versus our large cap counterparts.
When it comes to the deficit, and Lisa's point yesterday, this is really starting to gain momentum, but a lot of that is because 2025 is really going to be the climax of all of these issues. We're going to potentially hit our limit, and then of course they'll have these extraordinary measures to make sure we can still paying our debt until Congress gets its act together. And then of course there's the tax cuts. How are you looking at next year in terms of how much more the U.S. may add to the deficit?
Yeah, I mean, the way that we're looking at this as investors, because we're always trying to connect the dots between what's going on geopolitically and what it means for portfolios, is through the lens of bond yields. So you'll see it, right? You'll see it through higher bond yields if there's concern, if the market's pushing back on this idea that we're increasing the size of the deficit too much. But what we've seen over time is that demand for treasuries tends to outweigh supply. So if you see these bumps, if you see these moves higher in bond yields because of fears that we need to issue too much debt, eventually buyers are going to come in, especially if U.S. sovereign bond yields are so much higher than they are in other parts of the world. You look at places like China, their bonds are yielding 2.3%. Right now, you can get twice as much here in the United States. So I think that demand for treasuries is alive and well, which should mitigate fears of a runaway deficit spending.
Emily, with all of that, what's your highest conviction trade right now?
Yeah, it's tough right now. It's still bonds. We love bonds. You look at the aggregate bond index, it's yielding 5.3%. That is really close to the recent highs of 5.7. The 20-year high is 5.9%, and the 20-year average is 3.25%. So the fact that you can generate a 5 to 6% yield owning high-quality bonds right now, get paid income, even if you've got to wait for the duration tailwind to kick in, I think this is a great opportunity to really back up the truck and get that income and lock it in for years.
Emily Rowland, John Hancock Investment Management. Enjoy the party. Thank you so much for taking the time. We really appreciate it. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief. Danny Berger with us now. Danny.
Thanks, Lisa. Ceasefire talks between Israel and Hamas are at a standstill after the latest offensive on the outskirts of Rafah. Talks to pause fighting and secure the release of the hostages have been deadlocked for months. The two sides remain far apart on the status of Israeli troops in Gaza and for terms for the release of hostages held by Hamas. Now, the star witness in Donald Trump's criminal trial is set to return to the stand today after directly tying Trump to the hush money payments made to porn star Stormy Daniels. Former Trump fixer Michael Cohen elaborated on a trove of emails, texts, and conversations. His testimony is potentially the most damaging to the former president so far. Cohen gave a first-hand account of Trump allegedly giving directions to falsify records. And President Biden has announced sweeping tariffs on Chinese chips, minerals, and EVs. They affect about $18 billion of imports. Marvin Barth, founder of Thematic Markets, told me earlier that the tariffs go beyond just signaling to voters.
Of those trade sanctions, they're not symbolic. They are exactly part of an ongoing, undeclared, non-kinetic war between the U.S. and China. Yeah, you're not importing a lot of EVs now, but the point is you don't want to, and you're trying to protect industries that you feel are critical in times of national emergency, including warfare, by the way.
That was on Bloomberg Brief, which you can catch every morning at 5 a.m. ET. And that was your brief, Lisa.
Thank you so much, Danny. Up next, the consumer feeling the pinch.
Real wage growth has been recovering for much of the past year. It's starting to stagnate. Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
That's coming up next. This is Bloomberg.
Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations. Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
The last gasp of earnings season as we head toward a key slate of inflation data coming out starting in less than 90 minutes time with PPI. We can see markets trying to inflect higher, not really doing much of anything. 52.47 up about, 4 basis points in the S&P futures, which you can see at a 10-year yield lower, down from 470 on April 25th. Just to give you some perspective, 447.47. Crude really just steadying as people take a look at the supply and demand dynamics and decide, I'll pass on this trade. Under surveillance this morning, the consumer feeling the pinch.
Consumer sentiment has been one of those where it's watch what they do, not what they say. We have seen wages moderate, yet inflation is staying sticky. So where real wage growth has been recovering for much of the past year, it's starting to stagnate. Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
Here's the latest. Shares of Home Depot up slightly this morning, despite reporting a 6th straight quarter of negative sales. Investors also looking ahead to retail sales data tomorrow and Walmart earnings on Thursday. Joe Feldman of Telsey Advisory joining us now. I'm very pleased to say, Joe, thank you so much for being here. I want to start with Home Depot, this idea that the shares are gaining despite a miss pretty much across the board, as they really point to some sort of continuation of their forecast. Just how weak was it under the hood in terms of these results?
Well, the sales were definitely a bit softer than expected. And when you look at the U.S., same-store sales were down 3%, which was a little worse than expected. The EPS was a little bit of a beat by 3 cents. However, if you adjust or normalize the tax rate for what we in the street were thinking it was going to be, 9 cents of the earnings came from that. So it was a little bit softer from a quality of earnings perspective. But I do think that expectations were kind of low heading into this print. And so maybe there's a little sigh of relief in the pre-market trading. The pre-market trading is also quite volatile, so it's always hard to get a good read on what it is. But our understanding is that the company feels pretty good about the health of their consumer. It's just that their consumer is not spending on home improvement right now. They're choosing to spend elsewhere because of inflation and other pressures in the market.
How much is Home Depot kind of a story unto itself because of the home improvement angle and how sort of divorced the housing market has been from a number of other consumer-facing industries?
Yeah, I think that's a great point, Lisa, because home improvement is its own kind of world. You know, by definition, the homeowner is a bit more affluent as a consumer, tend to be employed, have good wage growth and good jobs. And so as a result, they tend to be able to spend a bit more. There was a lot of projects that happened during the pandemic, a lot of big ticket spending. People redid bathrooms, kitchens, bedrooms, living rooms. And so a lot of that has really slowed. So there was that pull forward. This year is still a bit of normalization from that. So again, that's why I feel like that core consumer has the capacity to spend, but they are deferring some of the current big project spending. Weather also played a factor in the quarter for what it's worth.
Joe, we'd love to get your take on Walmart, which is coming out later in the week, to really understand also what's going on with the consumer, especially as Walmart, according to the Wall Street Journal last night, is laying off people in their corporate space. Does this show that they are struggling at the moment?
I think I don't think Walmart's struggling at the moment. I think Walmart's business has been pretty solid. I think we're going to hear good things about traffic to the stores, people continuing to go at an increasing rate. I think we're going to hear that the food and consumables business is strong. Discretionary has definitely been a bit softer. I think Walmart, they've become a much more efficient company and focused on expense control in a much greater way. And I think that they're finding ways to leverage technology. And in some cases, it could replace some people at the corporate office. That's possible. But they are becoming a more efficient operator, which I think from an investment standpoint, Wall Street does like.
But from an economic standpoint, this is the U.S.'s biggest employer, 1.6 million people. Is it concerning potentially cracks in the broader labor market?
Yeah, I think they're just being efficient. I think any good company is always working through and trying to find efficiencies where they can adjust their business model. Remember, they just closed down the health business, and that was a big number of people from the corporate center. And by what I mean is those standalone clinics. They still have, pharmacies in the store, and they do offer clinic in services within the Walmart stores, but they had about 40 or so of these healthcare clinics that they are closing. They found that as a business model, it just didn't make sense for them to operate. It wasn't going to be profitable enough over time. And so they decided to close. That's really where I think you're seeing some of that pressure on the corporate side.
When we take a step back, there's been a real question about what the conclusion is from this earnings season. Just from the retail lens, can you give us a sense of how consistent the read is that, yes, there is this softening of consumer demand and maybe pushback on some of the higher prices, but there is stability in spending? Is that basically the ongoing story pretty much across the board?
That is what we're hearing, Lisa. I think that, we've seen spending has slowed, broadly speaking. We've also saw weather had an impact on that during this first quarter, the colder start to spring in many parts of the country. And so I think that we're hearing that from a lot of the other retailers that are out there. And broadly speaking, the consumer has softened a little bit, which makes some sense given all the pressures that are out there. However, generally speaking, you're seeing total retail sales are still up a couple of percent. Some of that is inflation. I get that. But the consumer, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible. I just think the consumer is being a little bit more cautious. Some of the pressure you're seeing is also related to services. I mean, insurance costs, healthcare costs, those are up significantly. We don't hear enough about that, I think, as it relates to the consumer. But, when your auto payment goes up quite a bit because of the insurance, plus the cost to lease a car or buy a car is up, that's a lot of pressure on the consumer.
Just quickly here, weather. Do you buy that? I mean, was it really that cold that really it drops 5 degrees and people say, forget it, I'm not going outside today? Are we that weak?
Well, I do think that there is a planting season, so there is some truth to it. I do think that some people tend to buy closer to need. We've seen that for the past several years now. You hear about it in winter when it gets cold. That's when people go out to buy gloves and scarves. And same thing with spring. I do think that people wait till the weather is a little bit better. We've heard, like Tractor Supply talked about, as spring improved, their spring sales picked up quite a bit. I think we're going to hear the same from Home Depot this morning, where they talked about spring started soft, but where weather got more normal, they started to see the pickup in demand. So there is some truth to the weather effect on retail.
They have to see the whites of something warmer's eyes before they go out and buy shorts. Joe Feldman, of Telsey Advisory Group. Thank you so much. You're not buying that, are you?
Well, also, where's spring? I feel like on the East Coast, at least, we've gone to winter to summer. And almost it changes every single day.
It changes every single day, and I wonder if what that means for later on. I'm sure we'll be complaining about a really steamy winter. You mentioned Walmart, and I thought this was interesting. It wasn't just cutting jobs. It was also saying that whole remote work thing, not so much.
And when I read that in the Wall Street Journal last night, I thought, who is still working from home? I know some companies still have a policy you can be flexible, but didn't remote work end? I mean, especially for a place like Walmart, people are out and about shopping in your stores.
Yeah, it depends. I mean, this is the corporate offices. They've got tens of thousands of corporate workers as well.
But all your workers are back in the stores.
And there's sort of a question of what is the importance of getting everybody back versus sort of signaling to people who've been back for the whole of this time. Coming up, former National Economic Council Director Gary Cohn. He's going to be speaking about all things, both policy and investment, as he is currently at the cross-section of both. Right now in markets, not a lot of action as we assess what is going to happen with PPI ahead of tomorrow's CPI and retail sales, the 1-2 punch, to give you a sense of whether we can kind of write stagflation out of the books. For now, this is Bloomberg. One hour to the beginning of a slew of blockbuster inflation data, beginning with PPI. Good morning. We are seeing markets doing nothing right now, basically going nowhere. They basically went nowhere yesterday, but they've come a long way going back since the third week of April. What we can see is a gain of about 5% in the S&P, a gain of about 7% in the NASDAQ. One share in particular seeing some particular gains, GameStop extending its rally up 118%. Welcome back, Roaring Kitty. People are very excited. Still, those shares down significantly, some 90% or so from some of the highs of all of the meme stock frenzies. We can talk more about whether that is the beginning of a new surge in it, or whether this is a frenzy, or whether this is just Roaring Kitty coming back and everybody celebrating. We'll talk extensively about that. We will not talk extensively about that. Right now in the bond space, you do see yields in just a touch, although again, some Noland in the market as we do wait for PPI, CPI, and retail sales coming tomorrow, 447.86 on the 10-year. And the currency space also really not doing much. We could see 107.97, a bit more euro strength. The question around whether this is a Fed prepared to cut rates regardless of what the inflation data shows. Under surveillance this morning, President Biden announcing new tariffs on China, targeting electric vehicle batteries and solar cells. In an interview with Annmarie before the announcement, Treasury Secretary Janet Yellen saying some form of retaliation from China is, quote, always a possibility.
The president believes that it's critically important for the United States to have a role and a presence in strategic industries like semiconductors and like clean energy that are going to be the foundation of good jobs and national security in the decades ahead. He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. and China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
The U.S. at the moment is spending just as much every year at this point on paying off our debt as it is funding our military. Does the U.S. need lower interest rates in order to balance the budget?
Well, we have to take the interest rate path that prevails in the economy as given. The president's budget incorporates the assumption that interest rates will be in line with the projections of private sector forecasters. So there has been an increase in the interest rate path that's assumed, and it's necessary to make sure that we're on a fiscally sustainable path. Of course, the higher interest rate path makes that more difficult, but the president's budget would hold the, I see the key metric that summarizes the burden of deficits as being its interest cost. And the president's plan would hold interest costs at historical levels and not allow them to rise above that.
That was Janet Yellen speaking to our own Annmarie Hordern, in part about what China's response would be. And we did get this morning, Annmarie, a response from China.
Yep, the Ministry of Commerce coming out and saying they vow to take measures to defend their rights. They say that they resolutely oppose what the U.S. is doing this morning with these tariffs. They say the decision is, quote, political manipulation, and also, Lisa, urging the U.S. to cancel the extra tariffs and correct this, quote, wrongdoing.
Let's see whether that works. Joining us for the rest of the hour is former National Economic Council Director Gary Cohn. Gary, so much to work through here in terms of whether it's tariffs, whether it's the fiscal policy, or whether it's the deficit. I want to start more broadly. This question of how much are from some of the fiscal policies directing investment theories right now in terms of where some of the money is going and what gates are being put up.
Well, look, fiscal policy and monetary policy are directly impacting how money is being spent, what money is available today. And I think that's even a more important topic. You know, we have gone through a pretty vicious cycle over the last 4 years where we went from a cycle of zero interest rates and abundance of capital available for almost all startups in this country and funding at various stages of your progression from startup to early stage to mid stage to late stage to IPO, to a place where we are today, where there's very little investment capital available for young companies and startup companies, and the IPO market just starting to reopen. So that is all a function of fiscal policy, monetary policy, because they're inextricably linked. You know, when people were not getting a return on their capital in the bank, and there was a zero risk assets out there, you know, people bought assets they thought could provide an enhanced return for them. So they were willing to take more risk. They were willing to invest in startup companies. Today, you can go out and buy a 6-month treasury bill and get 5.3, 5.4% on a tax preferential asset. So we have changed the whole mentality of the way people think about holding capital, investing capital, recirculating capital. Also, with the capital markets having been closed for so long, a lot of that capital that was invested 3, 4, 5, 6, 7 years ago, many of those people thought it had a 3, 4, 5, 6 year duration. They would get liquefied by taking those companies public, and then they would recirculate that risk capital back into the financial markets. They have not been liquefied because the capital markets have been closed. So therefore, that risk capital does not get to recirculate back. So a little bit of the natural cadence of capital moving in and out of risk assets has changed both because of fiscal policy and monetary policy.
There's a lot to unpack right there. Are you basically saying that on the monetary policy side, low rates usually benefit the smaller, more leveraged companies? Rates go up. That benefits more some of the larger companies that are able to be sort of term out their debt structures in a more considerable way. Are you saying that fiscal policy also benefits the bigger companies more because they're the ones that are eligible for some of these grants?
I didn't really say what you're saying. I don't think higher rates help anyone.
Okay.
Like if you're a large company and you're still running a large debt portfolio, you're always worried about your weighted average cost of debt, your WACD. So you're thinking about what that is, and the lower it is, the better it is. Ultimately, at the end of the day, you sell your goods or you sell your services to your customers. Then you've got your expense line, which is usually the biggest line in the expenses is salaries and costs. But then if you get down a little bit down, cost of debt is a big item. So to the extent that cost of debt goes up, the price of your goods or service has to go up. So companies, either the profit margins contract as interest rates go up, or they have to raise the price of their goods. So in a perfect world, no one really wants interest rates to go up. But there is a sort of middle ground where interest rates are at a level low enough where they're not really affecting, and the economy is growing without fiscal stimulus from the federal government. The question is really more when fiscal stimulus from the government comes in, how does that react? And right now, we actually have one of the most unique periods of time because we've got, on one hand, we've got the Federal Reserve, which is trying to raise rates to slow down economic growth, to get inflation under control. And we've got the federal government on fiscal policy on the other side, looking to invest capital to grow the economy. Those two things are countervailing forces. We don't see a lot of times in our economic history when we've got both of those things going on at the same time. Usually we're in unison. Usually the Fed's trying to grow the economy by lowering rates, and the government is trying to spend money to grow the economy. That's normally what you see as you're coming out of a very tough economic period. When you're in a very robust economic period, the Federal Reserve is raising interest rates, trying to slow it down, and the federal government does not need to spend money because you're in a very robust economic time. This time, it's very different than the historical past.
As an investor, who do you bet on winning? The Fed or fiscal policy?
I don't know if there's a winner or a loser. I think you have to be realistic to what's going on and who's trying to do what. The Biden administration has been pretty consistent on their fiscal policy agenda. They have been trying to spend money and put money into the economy since day one. Since the first COVID relief, $1.9 trillion, they put in early. And they continuously find ways to put money into the economy, as recently as relief of student loans. So they're continuously looking at ways to fiscally stimulate the economy. The Fed, on the other hand, is responding to the outcome of that money being put into the economy. There's a cause and effect. Many of us think the effect is so much money being put in the economy, the money supply expanding so quickly that you've got too much money chasing too few goods, and therefore you had an inflationary time and inflationary pressures. So the Fed is responding to the effect of the cause, and they are raising rates trying to slow that down. So if I were going to bet, the Biden administration will continue with fiscal stimulus. In fact, they have a lot of stimulus already approved where they have not given out the money. So that money has not fed through the economy. And the Fed will continue to monitor the financial conditions. And most importantly, they'll continue to monitor the path of inflation based on the data that they get. And they will decide what rate policy looks like based on that.
Gary, I want to ask you about the next fiscal fight, which is the Trump-era tax cuts. They're expiring next year. Do you think they should be extended?
So, look, I think tariffs is one of the most interesting topics that we dealt with when I was in the White House, and I think the Biden administration is dealing with now. It's interesting, despite a lot of rhetoric, the policies are starting to bend toward each other. It's hard to know the difference between the two, let's call them candidates' policies
today. Do you agree with tariffs? Because they're inflationary.
I'll talk about tariffs. So when you look at tariffs and you think about tariffs on things that we manufacture in the United States and we can sustain ourselves, I think it makes sense to tariff a country that is importing things in the United States at a below cost. So we know that China has some real economic advantages. We know that they don't pay fair market labor. We know that they don't have a cost of capital. We know that they don't have environmental restrictions that U.S. companies have. So we know they've got a competitive advantage. So if they're using that competitive advantage to dump products in the United States that we make, and therefore they're displacing U.S. manufacturers and U.S. jobs, yes, we should protect our border. On the flip side, if they are exporting and we are importing goods that we need, that we do not make in the United States, and there's no replacement for us in the United States, and we put a tariff on it, it basically becomes a consumption tax. You and I and all of us are going to buy those products. We're now just paying more for the same product.
Do you think that we're going to see more of these walls go up, whether or not Biden or Trump get in the White House next year? Like, how high are we talking?
You know, I think there's a thought right now that the wall should go higher. I think at some point there is diminishing returns. You know, we've got a lot of historical data on putting tariffs in, whether there were old steel tariffs under other presidents. When I was in the White House, we did a 301 on washing machines. And if you look at the whole theory of what happened with washing machines, it's quite interesting. You know, we put tariffs on washing machines, but the prices of dryers went up equally with washing machines because, you know, the manufacturers think, well, people think washers and dryers cost the same thing, even though one had tariffs on it and one didn't. You know, very inflationary to buy a washing machine and a dryer. Did it bring manufacturing back to the United States? Yes, it did. We brought the foreign manufacturers, you know, the LGs and the Samsungs that were importing in the United States. Did they open manufacturing in the United States? Yes, they did. So we did create some jobs, but we really increased the price of the washing machine and the dryer. So there's a lot of historical data on what happens when you tariff things.
Gary Cohn, you're going to be sticking with us. We've got a lot to talk about. Up next, clinging to U.S. exceptionalism.
And I feel we kind of clung to this American exceptionalism too long. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now.
That's coming up next. You're watching Bloomberg Surveillance. It's a quiet day at a time when a lot of people are looking to PPI data coming in about 45 minutes, heading into tomorrow's CPI, as well as retail sales. We do hear from Jay Powell today as well, which should be interesting given how many people are banking on the Powell pivot. Let's get straight to it. Under surveillance this morning, clinging to U.S. exceptionalism.
And I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months ago, yet all you heard was American exceptionalism, American exceptionalism, American exceptionalism. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now.
Here's the latest. Treasury yields holding steady ahead of U.S. PPI data. In comments from Fed Chair Jay Powell, Ed Al-Husseini of the Columbia Threadneedle writing this: the shocks that now largely played through the system. However, the distribution of inflation has not fully shifted back to a level centered around 2%. Ed joining us now. Ed, want to get your view on whether people are too optimistic about the disinflation trends and maybe this pivot that the Fed seems like they're not totally or all on the same page with.
Yeah, I mean, look, largely it's a matter of timing. And what we're realizing now, especially looking at the data over the course of the past 6 months, is you can get a lot of short-term shocks in month-to-month data. In Q4, inflation decelerated perhaps a little bit faster than the underlying trend. In Q1, we saw data move up a little bit faster than the underlying trend as well. If you average it out, inflation is still trending somewhere between 2.5% and 3%. And the question is, how much time will it take for us to squeeze back that 50 to 100 basis points in the course of the rest of this year?
Right now, actually, this morning, we haven't mentioned this yet, but we did get the Small Business Optimism Index, and it actually increased for the first time this year, in large part because small businesses saw the potential for prices to go down. Many fewer people expect them to keep going up. Is this the kind of data you follow at this point more closely than even PPI or CPI, given some of the lag effects that a lot of people are pointing at?
Yeah, I have to be honest, soft data has given us a lot of false signals in the course of the past 2 years. I mean, you start with PMI data. A lot of the survey-based data has had the economy in a relatively weak position. That's at sharp odds with consumer spend. It's at sharp odds with CapEx. And it's at sharp odds with just the broader inflation story. So, yes, there's a place for soft data, like the NFIB survey and so on. But largely, it's been a false signal.
Meanwhile, we have Gary Cohn here, former National Economic Council director, as well as the part of the board at what we're looking at more broadly. I'm wondering, from your point of view, how much are you seeing in the companies that you oversee and you invest in this ongoing disinflation?
I don't think we're seeing a lot of disinflation at this point. You know, in the enterprise world, in the corporate world, there's not a lot of disinflation. In fact, most companies right now are trying to figure out how to run themselves much more efficiently because there are a lot of price constraints in the system, and there's becoming less and less ability to push price down into the customers. The customers are becoming much more discerning. So I think what you're seeing in big and small companies today is they're trying to figure out how to run themselves more efficiently. You know, the AI trend is clearly something that everyone's looking at. How can that help me in the efficient frontier? How can I be more efficient with my people? How can I be more efficient with my technology? And we're seeing that in big and small companies today.
When you look at potentially like Bank of America coming out and saying they're warning that the stock rally is exposed to stagflation risk, do you see potential stagflation in this economy?
You know, I'll quote the chair. The chair. I don't see the stag and I don't see the inflation. We're still growing. We're still growing at 1.5%, 2%. And the inflation is pretty steady. Look, I think it is. I think we agree that it's going to be harder to get inflation down. The last mile is very difficult. There are a bunch of issues in inflation that higher interest rates won't cure. You know, we've got a commodity bull market going on right now. We've got uranium prices and copper prices and anything having to do with the electric power grid going up pretty substantially. You can raise interest rates as high as you want. The demand for electricity between EVs and between GPUs and CPUs, it's not going away. So we've got some fundamental shifts going on that are going to take some time to just work through the system.
Jeff Curry with his copper bracelet kind of banking on that. Ed, from your vantage point then, how much are people over their skis with respect to betting that the Fed is going to cut rates this year, potentially twice, especially as Fed Vice Chair Philip Jefferson yesterday said he favors holding rates higher for longer because, frankly, we're not seeing that disinflation.
Yeah, and the question is, where do you look for that disinflation? I think one of the key stories for me has been the slowdown in wage growth. In fact, I've been surprised by how quickly wage growth has slowed, given the underlying dynamism and the strength in the labor market. If that pattern continues, again, it builds the foundation for the Fed to have confidence that, one, inflation expectations are still in the right place, and two, that center of gravity, the combination of inflation expectations and wages, will pull that inflation down. So, yeah, 1 or 2 cuts seems pretty reasonable to me right now.
Do you think they come before the election?
It's tough. I mean, look, we're struggling to get our hands around the inflation story. That's going to come first. That's going to be the primary source of the timing here. Do they have room before the November meeting to move? At most one at this point. The calendar is definitely working against them. You have to build confidence in the data.
Gary, you laughed. You think it's going to be an issue?
No. I think I'm in the 2 camp as well, and I think one will definitely come before the election. But as the Fed chair, you're sort of in this precarious position that if you do it too close to the election, people are going to talk you're being political. But the Fed calendar is set years in advance, and so there's only. Look, in this environment, there's only certain dates you can do it. I'm old enough to remember when the Fed had emergency meetings and cut and raised interest rates whenever they wanted to.
Yeah.
I don't think we live in that environment anymore.
Let's rip up the script a little bit. If you were National Economic Council right now, and I know it's the other side to President Biden, what would you be doing differently with messaging? Because they're not getting the message across about disinflation. And frankly, inflation is one of the #1 issues.
Look, I do think they have to figure out a different tactic on messaging. I mean, we see it in the data. We see that the data tells them very clearly that, the top 1 or 2 issues that voters will vote on is the economy. And when voters in America talk about the economy, it's a very simple equation. Does what I bring home at the end of the week or the month or whatever my pay period is, does it buy me more or does it buy me less than I thought it'd buy me when you came into office? So therefore, is my disposable income going up or is my disposable income going down? The Biden administration has to figure out a way to convey that you are better off today than you were 4 years ago. And if they can't figure out a way to convey that, they will lose on this messaging. And the Republican side has done some very interesting marketing on putting out the basket of groceries and showing what the basket of groceries cost 3.5 years ago and what it costs today. The Biden administration has to go out and say, look, this is what you were paying for. This is what you were getting 3.5 years ago. This is what you're getting today. Here's what I have done for you, and here's how I have done it. They've got to actually put a sort of a point on the issue instead of talking theoretically.
Well, they're trying other things. Like this week, they're calling it Infrastructure Week, real Infrastructure Week.
Really?
You see all
I never heard that one before.
Well, why is that not landing? I was with Yellen talking about broadband in rural areas. Why does this land?
Well, I don't know why it doesn't land, but at the end of the day, I heard her talking about bringing broadband. They were in Virginia or West Virginia yesterday, bringing broadband to 700 families. You can take Starlink and bring broadband to 700 families in a minute. You can give them a Starlink password. They brought Starlink to Ukraine literally overnight. And so these are things that are interesting and they're good and they're important and everyone should have the internet. No one should argue about that. But these are not major events. And for those 700 people that got internet, it's really important. It doesn't move the needle in the country. You've got to talk in a bigger swath of people when you're trying to move the emotion of the country.
Well, people have their shovels ready. We were talking about that. Ed Al-Husseini, too short. I apologize. Columbia Threadneedle, former National Economic Council Director Gary Cohn, thank you so much. As we do look forward to the PPI data coming up, Chris Marangi of Gabelli Funds, Bank of America's Elias Galou, Lara Rame of FS Investments, and Bloomberg's Gina Martin Adams. We are watching Bloomberg Surveillance on PPI Day.
Economic surprises have really plunged over the last couple of weeks and are now in negative territory.
The momentum in inflation in the last 3-4 months has just been moving in the wrong direction.
The tighter policy is, faster should be the fall in inflation. So what the Fed is doing is undershooting here.
We don't see any data to indicate that they're suddenly going to have to cut by 4 or 5 times by the end of the year.
We're going to wake up one day and realize, whoa, things aren't as good as we thought they were.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is it, the moment you've been waiting for. 30 minutes until PPI, kicking off that inflation data. Have we reached the pivot point that so many people have been looking for? From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. You'll get your good morning tomorrow. John Ferro will be back. Annmarie Hordern here with myself, Lisa Abramowicz, together with Lara Rame of FS Investments. I will get my words out for this hour. I am very pleased to say, as we take a look at whether we can get to that place of maybe more concrete disinflation. So far, Annmarie, we've gotten a host of Fed speak. It's been all over the place with respect to either leaning into this pivot or leaning out.
Well, this is what Philip Jefferson said yesterday, that actually if you have a whole host of Fed voices coming at you from different angles, it's hard to decide where the Fed is looking. But when it comes to PPI today, CPI tomorrow, and then, of course, the PCE that we'll finally get, you have to also look at other data. I go back to yesterday's Federal Reserve Bank of New York report. Americans last month braced for generally higher inflation pressures over the next few years. That is not something you want to see if you're sitting at the Federal Reserve.
Which is a reason why there's a real question about whether the market has too much confidence about the disinflation narrative. And the Fed pivot that we heard from Emily Rowland is still very much a go. Lara Rame, welcome. Thank you so much for being with us today.
Yeah.
I know you're in the higher for longer camp, and you think people are underestimating the inflationary pressure. What have you seen recently, whether it's in earnings or whether it's elsewhere, that gives you that conviction?
It's been the whole picture. It's been wages as well. It's been the fact that unit labor costs are up. It's been the fact that we also had the University of Michigan numbers last week. You know, I love the Bloomberg Economic Surprise Index. You can sort of pull out pieces of it, and the inflation piece has been shooting higher because it's not just that inflation's been stubborn. It's been so much more stubborn than everyone has expected. And I think the markets still have this filter where they want to ignore the bad news on inflation and they want to get so excited and embrace good news. We may very well have a well-behaved, let's call it, PPI number today and a CPI number tomorrow that gives us a 0.2 increase. But I think underneath this is still that whack-a-mole sensation where inflation's kind of coming at us from unexpected places. And maybe it's not all together, but it's kind of popping up when we least expect it.
The expectation for what we get in about a half-hour time is 0.3% final demand month-over-month PPI, up from 0.2% in the prior month. Tomorrow with CPI, the expectation is 0.4% increase from just sort of staying constant. We shall see. Right now in markets, things steady. Not exactly a lot of drama going on as people parse through all of the earnings as we come to a close of the earnings season or get to the tail end of it. And as we look toward that PPI data, basically not going anywhere for S&P futures, unchanged. We could see yields just marginally lower. Not a lot of action, although you are seeing in GameStop up more than 117% as people take a look at what's going on with the meme stock frenzy. You can make of that what you will. Coming up, we're going to be speaking with Chris Marangi of Gabelli Funds with stocks stuck in a tight trading range ahead of U.S. PPI data. Bank of America's Elias Galou on the latest fund manager survey, and Bloomberg's Gina Martin-Adams on the resurgence, as we just mentioned, of meme stocks. Right now, stocks stuck in a tight range ahead of U.S. PPI data due out just about 30 minutes from now. Chris Marangi, meanwhile, we're talking to Laura Rame here at a time where there is this question about what you're going to be looking for. Right now, what is your base case? How people will react one way or another, upside or downside surprise?
I think if we get an upside surprise in inflation, simply because the trade is so crowded that we're going to sort of finally see this disinflationary path resume, I think we are going to get a jump higher in interest rates. When I look at the overall interest rate picture, to me, it's very much one of renormalization to where we were back, even before the financial crisis into the mid-90s. I think we're going to be, as you say, in this higher for longer place. But I also, when I see the range of possible data outcomes, people have no consensus around what the Fed's going to do. I see right now every data point is a possible flashpoint for volatility, and I think we're going to continue to see that today.
Chris Marangi of Gabelli Funds seeing more signs of the economy slowing and taking a defensive approach to the market, recommending the less cyclical industrials, live entertainment stocks, staples, and utilities. Chris joins us now. All of those things are not the same in terms of defensive, and I want to start there. Live entertainment, defensive?
Well, it's actually one area where there's the secular tailwinds have outweighed any kind of cyclical headwinds. Lara's obviously been talking about inflation, and Gary Cohen said he hasn't seen inflation or stagflation, but you can't lose sight of the stag part. Economic growth is slowing, it would seem, in most areas, but the consumer is still spending on live experiences, going to concerts, going to sports events, et cetera. And there's limited ways to play that in the market, but we're taking advantage of them.
Basically, you can bet on Taylor Swift even in a slowing economy. Chris, at this point, how have you shifted some of your allocations? I know you like to focus on specific companies that you like. Is there something that has made you shift in the earnings, in some of the softening that you're seeing in the discretionary spending?
Not really. We're always looking for companies with pricing power. We're looking for companies that with good managements that can adjust for different financial conditions. Obviously, financial flexibility on their balance sheets. But we are being a little bit more defensive, as we noted. I don't think we're late cycle. We are late cycle here. I don't think we're ready for a new economic environment. We're obviously waiting for the Fed like everybody else. But focus on the same good companies that we've owned for decades.
Lisa mentioned this at the top of the show, but now I see Tupperware is up more than 10% this morning. So I have to ask, are meme stocks back?
It would seem that way, just when you thought they were gone. And this is not inconsequential. This is not the kind of behavior that you see when financial conditions are tight. So the Fed, I'm sure, is watching this and seeing what happens. Those of us who manage small cap funds remember 2021 quite well. There were 3 stocks, AMC, Bed Bath & Beyond, and GameStop, which added about 300 basis points to the Russell 2000 Value Index. It was about 10% of returns that year. Nobody owned them. No institutional managers owned them. And then they came out and they crashed after they were removed from the index. So, you've got companies like AMC taking advantage of the situation, raising capital at what appear to be very cheap rates. And we'll see what they do with it. But this probably has some legs.
Chris, when you look at the small cap universe, it has been underperforming the large cap space. I know there's a lot of dispersion within the small cap space. What do you view as a broader mega trend within small caps? It does seem like, aside from a couple of standout positives, the quality underlying the Russell 2000 is deteriorated.
Yeah, obviously the Russell 2000 value, which we're focused on in particular, is over 20% financials, and there's some real questions about the quality of those earnings and those companies, particularly the balance sheet with the asset side, with the commercial real estate exposure. The companies tend to be more cyclical, have less pricing power, more levered balance sheets in general. But we are finding good companies within that, and that's the opportunity to beat the index.
And when you, I think, look at this broad opportunity, do you see a difference between the way that small caps are insulated from geopolitics, or do you feel like they're really more beholden to the broader cycle?
Yeah, certainly they are often viewed as safe havens, obviously with a domestic focus, and that's an attribute in times like this. But they are, in many cases, very cyclically sensitive, and it's the one thing that sort of keeps us from being all in on small cap, given some of the concerns we have about the economy. But the valuation gap is quite wide, and you're really getting paid to take those risks today.
Meanwhile, people are all looking to what's going to happen in about 21 minutes' time when we get the first read of a pair of inflation readings. What are you looking for? How will you respond to either an upside or a downside beat?
Probably not responding at all, to be honest. I mean, listen, this is another data point in the continuing narrative. Do think that the Fed will cut later this year, but the path to normalize rates and normalized inflation is going to be longer than the market perceives.
All right, so if you're not going to really respond one way or another, how have you basically adjusted your viewpoint going out based on earnings as they do come to a close, really capped off next week by NVIDIA?
Yeah, again, I think probably a bit more defensive, a little bit more cautious than I was the last time I was on 3 or 4 months ago. We are definitely seeing some signs of slowing. And I think one thing to keep in mind is, 3% is sort of the new flat. As you look at top lines, if companies aren't growing the top line at that kind of rate, they're probably losing ground. They're either not pricing up or they're losing some volume. So we are in a different world, obviously, than we were just a year ago.
Chris Marangi of Gabelli Funds, thank you so much for being with us. Laura, that is something that we've been hearing, that there has been clear slowing down. Why is that not enough to really offset the inflationary pressures that you see as being sticky in the system?
I think it's several reasons. One, we just cannot underestimate this wage component. I think that is something that is, here with us for some time. The labor market remains incredibly tight. I think it's also the housing piece. And, hopefully it's something we can dig into a little bit later. But these rent prices have just not come down as much as people expect. And if we do get some relief, I expect it to be short-lived, because in Q4, I think we're going to be right back into an apartment shortage again. So it's a confluence of things. And boy, those two pieces are huge when you think about the household monthly budget.
That rent is just too damn high. Is that what the potential calendar is? We also are going to be talking about tariffs and what's going to be happening with that. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Chevron's bid to buy Hess has hit a snag. Investors are being urged to abstain from voting for the deal. A shareholder advisor cited concerns about its valuation and a dispute involving Exxon over an oil project in Guyana. It's yet another blow to what would be Chevron's biggest deal in 2 decades. Now, moving on to Kraft Heinz, it's looking to sell Oscar Mayer, the maker of lunchtime fixtures like hot dogs and cold cuts. The Wall Street Journal first reported that Kraft Heinz reached out to Bank of America and Centerview Partners to gauge interest in the brand. Sources said that Oscar Mayer could fetch something in the neighborhood of $3 to $5 billion. Kraft is in the middle of a multi-year effort to improve the nutrition of its products. Now, Swiss shoemaker On has posted strong first quarter revenue. It boosted its sales forecast on strong demand for its running shoe and a new line of apparel. The Roger Federer-backed brand has expanded rapidly across Europe and North America. On is now looking to broaden its reach into tennis and training, trying to take market share from more established rivals like Adidas and Nike's. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, rate cut bets driving bullish sentiment.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in. and that will ultimately set up this bull market to last for years to come.
Expect more discussion on insurance cuts, on cosmetic cuts, on other cuts, welcome cuts. It isn't easing. That's what they want to say. That's next. This is Bloomberg Surveillance. This is Bloomberg Surveillance on PPI Day, heading into CPI Day, heading into whatever other acronym that you're going to look at that will maybe give you a sense of whether we're disinflating on track. Right now, market's doing nothing, although inching just a little bit higher, 52.48 on the S&P. Yields inflecting lower, and really it's the round trip that we've seen, both rising to the highest that we've seen going back more than a decade now. 447.86 on the 10-year. It was 470 as recently as April 25th. Under surveillance this morning, rate cut bets driving a lot of the bullish sentiment you see out there.
I do think that the Fed is going to cut rates before the end of this year. I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
Which is a reason why there's been some confusion, particularly among investors surveyed. Here's the latest. Fund managers are the most optimistic about the state of the market since November 2021. That is according to the most recent Bank of America Fund Manager survey. It also shows cash allocation at a 3-year low and stock allocation at the highest since January of 2022. Elias Galou of Bank of America Securities joining us now. Elias, how do you explain this, especially given the fact that in the survey, people are ratcheting down their expectations for earnings and growth?
Hi, it's a pleasure to be here again. So yes, this was pretty much the most bullish survey of the past 2.5 years. We had already seen in recent months a rising optimism regarding FMS investors, but the one notable development in the May Global Fund Manager survey is that the remaining bullishness is no more driven by improvement in global growth expectation, but by a big conviction that global monetary policy will be easier in the next 12 months. We recorded big convictions that the Fed will cut rates in the next 12 months and that both short and long-term interest rates will be lower by this time next year.
Elias, I know your colleague Michael Hartner was talking about the risks that this poses in terms of vulnerabilities. Should there be a downturn in terms of economic activity as expected, but stickiness in inflation? How pivotal are some of the prints that we're going to see, including PPI coming up, to really indicate whether people are going to get wrong-sided on this one?
Look, the next report on CPI and retail sales tomorrow will be very important because when you look at this month's Global Fund Manager survey, investors, yes, are slightly less optimistic on the macro, but overall, when you look at over the past 3 years, they remain quite optimistic. When we look at recession expectations, about 2/3 expect that there will not be any global recession, and specifically to the US, about 2/3 as well expect that the US will not experience any recession in the next 12 months. And investors are still convinced that the dominant macro scenario in the next 12 months will be a soft landing. It also seems that no landing odds have peaked, hard landing odds have troughed, but as you said, the biggest tail risk is inflation, and the biggest surprise would be an outcome of both higher CPI and slower economic growth, why the tomorrow's CPI report will be very important.
Which would then mean the likelihood of the Fed cutting, that starts to become less of a possibility. What happens if the Fed does not cut? Given, if you look at this survey, the majority expect that this is going to happen at some point this year or beginning of next.
So it's the big conviction of this survey. 96% of FMS investors think that the Fed will cut. When asked about the timing of the first Fed cut, 82% expect the first Fed cut to happen in the second half of this year. And when asked about the magnitude of rate cuts, over three-quarters expect that the Fed will cut at least 2 or more in the next 12 months. So solid conviction that monetary policy will be easier. But if inflation spikes higher, that's the big risk. And if it does so, the Fed will be less likely to cut. And you see the inherent risk between no Fed cut, that is not expected at all, and higher odds of economic hard landing, which is now the number 3 biggest tail risk in this month's survey.
Elias, I think this speaks to one of the core questions dominating markets today. Can we continue to see a bull market run with higher interest rates? And I think if you and I were sitting here in January, back when we were expecting 7 rate cuts, that was what was priced into the market. And I told you, by May, we'll only be pricing in 1.5. And markets are going to be fine. I think we would have really had trouble believing that. And yet here we sit today. So even though I recognize the conviction in the rate cuts in your survey, I think if we don't get any rate cuts this year, the markets could still continue at least to be stable where they are. Let's face it, we're at very high valuations today. It doesn't seem like rates have really caused that much of an issue for markets or for market sentiment, as long as the growth is there.
And that's the key point, as long as the growth is there. As you said, rate cuts expectation have come a long way from the lows in January, but the main element is that growth has held up in the first 4 months of this year. And that is why we were recording in the different surveys in the recent month improving growth expectation. This time, macro sentiment has ebbed, but the conviction regarding easier monetary policy still stands at very, very high level. So the one macro development to watch now is inflation, of course, but can growth remains at resilient levels? And yes, if growth slows and inflation stays sticky at high level, that would be the most contrarian outcome for investors.
Well, and I think when you think about growth slowing, this is also where you need to start to really get granular about numbers, because if we're growing around 3% right now, Q2 GDP estimates, early estimates are as high as 4%. When you talk about slowing, are you talking about slowing to 2.5%, to 2%? It sounds like we're nitpicking about numbers, but this is the kind of magnitude that matters when you're at today's really stratospheric valuations.
Sure. I mean, the magnitude in terms of a slowdown is, can the global macro remain on a path towards a soft landing? If investors still believe that soft landing will remain the dominant scenario, and that is the case this month, with 56% of FMS investors say soft landing is the main scenario for the global economy in the next 12 months, then I think it's going to be a rather smooth path for risk assets. But you're absolutely right. The one investment conclusion from this month's survey is that positioning is no more the tailwind it was in 2023, and risk assets are definitely more vulnerable to evidence of higher inflation and a slowdown in economic growth.
Basically, Elias, if we could reframe this based on the trajectory of the fund manager survey over the past 6 to 12 months, how much do we see a pivot party priced in, a pivot party slightly priced out, and now fully priced once again?
Look, I mean, investors believe the Fed, and they are also data dependent. And for now, they are still holding to the view that a soft landing will happen, that no recession will be happening in the next 12 months. So soft landing, no recession, macro sentiment that remains near the highs observed in the past 3 years, and a conviction that large cap growth stocks will be the leader in terms of the bull market. And that is why investors' positioning is the most bullish of the past 3 years.
Elias Glou of Bank of America. Have fun hanging out with Brian Moynihan over in Paris as everyone, all of the executives in the finance world, descend on the region. Coming up next, we have breaking U.S. PPI data. But Laura, I wanted to follow up on something you were mentioning. This idea that we've been able to handle pricing out rate cuts substantially and valuations have hung in there. Do you agree with the point that Elia was making, which is there seems to be a vulnerability, a greater vulnerability now based on what people are pricing and based on their positioning, say, than a month ago?
I do. And I mean, by the way, how nervous? Am I the only one that's nervous? Like, I feel like a year and a half ago when everybody was calling for a recession, we didn't get one. And now everybody's bullish and the conviction in a soft landing is at all-time highs. I think that should be, a warning sign that we need to just continue to monitor diversification, to not put all our eggs in one basket.
Also a great point. What did we learn from the recalibration of 7 cuts to 2, maybe 1?
We learned, I think, that we need the growth to handle the higher interest rates. I think that is, to me, where we go from here. I know that obviously the focus and the Fed, it's really about inflation. But when I think about market performance, growth is necessary for us to accommodate these higher rates. And I think we're stuck with the higher rates, where the growth now, to me, is going to be what market performance hinges on.
I would also argue that when people are pricing in 7 rate cuts, they were pricing in the chance of a hard landing.
Yes.
And currently, it seems like people are pricing that out. So if that gets priced in a little bit more, that's when it's going to be a little bit more difficult to swallow. Coming up, we get that PPI data. The expectation is for a 0.3% month-over-month gain, up from 0.2%. How the markets respond, kind of key. If we get an upside surprise, how big of a problem and a disruption is that going to be? A downside surprise, how much of a rally will that unleash? This is Bloomberg Surveillance. Here's the state of play, 25 seconds away from PPI data, which is in some ways the appetizer for tomorrow's CPI data. Markets basically stagnant as we wait to understand whether we can really get on this soft landing bandwagon. Although S&P has been up about 5% since the end of the 3rd week of April. You can see the NASDAQ futures doing nothing also, but up. Those have been up about 7% since that same time. Right now, we are getting that data. Michael McKee here with us to break it all down. Mike.
Bit of a fattening appetizer for you. We've got a 0.5% rise in PPI for final demand, the headline number. That compares with 0.2 the prior month. And for the core, also 0.5% rise. And the core X trade as well, up 0.4%. All these significantly higher than and had been forecast and significantly higher than last month. On a year-over-year basis, the final demand goes up to 2.2% from 2.1%. That is as expected. 2.4% for core. That's the same as last month. The forecast was for it to fall to 2.3%, and the core X trade is at 3.1 from 2.8. Now, here's an interesting revision. Headline PPI revised down last month to a negative 0.1% print from 0.2%, and the headline core also revised down from 0.2 to a negative 0.1%. So what that leaves us with is index values that aren't as high as the monthly change would imply, but they are still significantly higher than anticipated. So we do have some inflation in the producer price area, and I am guessing, Lisa, that we have some reaction in the markets.
We do, however, it fades. Mike, stay close as you parse through all of the details in a very detailed report, which we will get into in just a second. You can see that initial pop in yields, that sell-off in price, fade just a touch as people realize what Mike was talking about, which is that the revisions in the prior month leave this a little less of a surprise to the upside as many people had expected. In the yield space, you're not seeing as big of a reaction, just about 3 basis point increase in the 10-year yield, more market than the 2-year yield seems to not really move things. In the equity space, though, you did see a bigger downside surprise in terms of how markets were responding, down about 1/3% on S&P futures, down almost 0.5% on the NASDAQ. Russell futures not really doing that much. The question here is something of an inflationary pop that is more than expected worse news right now for equities then for bonds. Mike, you've had a second to go through it. What's the latest in terms of some of the details that you think we should pay attention to?
Well, headline pushed up a lot by heating oil and by natural gas. Both were up about 5%. That's a significant rise during the month, especially in a month when you're thinking you may not need the heating oil anymore. But I think what will catch most people's eye who are nerdy enough to look at this is portfolio management. This is what I have always called the POGO part of the PPI and CPI. We've met the enemy and he is us. When the markets go up, the market managers get more money. And that is what happened. Portfolio management up 3.9% during the month after just a 0.5% gain the month before. In March, we saw the markets go down, 0.5% gain. Now it's a 3.9% gain, with the rise in equities especially having an impact on this. This goes into the PCE, as does healthcare services. So those are things that are going to, you're going to see over the next few days, maybe people revising up some of their PCE estimates.
Just to recap, if you are just joining, we did get a strong upside surprise in the headline number for PPI final demand, coming in at 0.5% versus the expectation of 0.3%. At the same time, a revision lower in the prior month to a negative 0.1 print from the initially reported 0.2%. So you put it together and it is still an upside surprise, but not as big as it might seem on first blush. The market response is a sell-off in stocks, in bonds, which you could see is yields shifting higher, although retracing some of the initial move as people parse through some of the details. And when you push it through the foreign currency market, where you could see foreign exchange market, you could see a bit of a stronger dollar versus the euro on the margins as people price out what this means for a Federal Reserve looking for some sort of disinflationary trend. We are getting some more revisions now for final demand year over year, also being revised lower for the prior month. So coming in at 2.2% for final demand this past month in April, with the sort of in line with expectations. So again, not as much of an upside surprise as people had expected. Laura Rame with us here of FS Investments, and I'd love to get your take on just how much this sort of edifies your viewpoint that it is sticky, it is higher for longer, and an important thing to watch heading into tomorrow's CPI.
Yeah, disinflation has stalled. I think that's the trend that I continue to see. And when you look ahead, you know, we've had a lot of tough talk out of the administration about tariffs. You know, the little relief that we're getting on the inflation front is more coming from goods. And that looks unlikely. That sort of global trend of lower goods prices seems unlikely to stay with us as, you know, sort of all of the low level news that leads us to create our top line CPI forecast is just continuing to push higher. This is another piece of it. I think we see pressure in commodity prices, for example, services prices. So when you look at it all up, I think today's number, monthly index data gyrations notwithstanding, the disinflationary trend is stalled out, and that's what I focus on.
Does this spell bad news for tomorrow's CPI?
I think that's what markets will probably push into their expectations. I do think that there's a lot of hope. Hope is not a strategy, but I think there is a lot of hope that after several months of upside surprises, we're going to see a more moderate CPI number tomorrow. But when I look at the headline consensus expectation, 0.4%, that is a number that is inconsistent with the Fed's 2% target. We're just still running too hot for the Fed to comfortably cut rates significantly with the economic data as strong as it is.
Mike, as you look through the PPI, what are you picking out that potentially will spell bad news for PCE?
Well, the healthcare and the portfolio management are two things that will. We also keep an eye on airfares. They're calculated differently between the CPI and PPI, and so you got to kind of split the difference, and that'll go into what the PCE does. The PPI does not do residential housing, and that's going to be the big question tomorrow. PPI does construction, businesses construction, office construction, but the CPI and the PCE measure housing and slightly differently, and the question is, do we see a big change in housing? That will be probably the big mover tomorrow, besides some energy prices in the CPI.
I think the question, and I'm curious is your opinion on this, because I hear a lot of cherry picking when we think about inflation indicators. Some, have a bigger weight on housing. Some have less of a weight on housing. We know the Fed targets the PCE deflator, which is running cooler than the CPI number. But I don't think that we can just discount the CPI data simply because we don't like what it shows us versus what the PCE deflator does. I mean, how do you sift through really a growing cacophony of different inflation indicators?
Well, it's the old saying about what you see depends on where you sit. If you're sitting at the Federal Reserve, you're looking at the PCE, and you know that owner's equivalent rent in the CPI is a misleading indicator, and it doesn't really necessarily tell you what's going on with inflation overall. So you look through that somewhat. If you're at 1600 Pennsylvania Avenue, you're looking at the CPI because that's what most Americans are looking at, and you're worried because it's still too high. If you're at Health and Human Services, you're looking at the CPI because that's the deflator that gives you what the Social Security increase is going to be the next year. So it all depends on what you're using the numbers for. I think people on Wall Street know that the Fed looks at PPI. They look at CPI. We'll get a reaction tomorrow because they'll be looking at it as sort of an indicator for where PCE will go. But they know that the Fed's looking at PCE. And if it doesn't start going down again, they know we're not going to see any rate cuts soon.
If you are just joining us, we did get that PPI print. It did come in, at least the headline number, hotter than expected. But the market reaction fades as people look beneath the hood and really see that it wasn't that significant of an oversight, of an overshoot based on the downward revisions in the prior month. You could see S&P futures almost back to flat. You could see a similar reaction in bonds with yields almost flat on the day, pretty much across the board as people assess whether this really is something that points to higher inflation, the foreign exchange trade. You can also see a similar type of revision, although, again, there's a question of how much the U.S. is going to be ahead or behind, I should say, of the European Central Bank when it comes to cutting rates. Laura, you said that disinflation has stalled. That is your takeaway. What gives you that confidence when there are certain aspects of this that very much just are a de facto product of the times, like portfolio management fees?
Yeah, when you really look underneath the headline inflation data, what you see is a huge difference now between what's going on the services side of the economy and the goods side of the economy. Goods price deflation is almost back to where it was before the pandemic, but the services component, and our economy is, for all intents and purposes, a services economy, is running much, much hotter. And it's a combination of rent, but it's a combination of a lot of other, the Fed's sort of ostensible super core number that is also a reverse course, and inflation in that area is rising. And so when I add it all up, the resting heart rate of the U.S. economy, sort of outside of that goods price deflation, is significantly higher than 2%. It's higher than 3% right now. And the services piece is what is notoriously stickier. And outside of rents, I think you've got this wage component that is going to keep it all overheated.
Do you think it would be a policy error at this point for the Fed to cut twice this year?
They seem to really want to cut, and frankly, I don't think 50 basis points is going to move the needle significantly on demand. I do think that we should all have confidence in the fact that, our economy is solid today. My outlook is positive. If the economy does start to stumble, the Fed has room to cut. But I almost feel like they have boxed themselves into a corner. They seem to want to cut so badly, and they're so focused on the fact that rates are restrictive. When I look at markets, I don't see rates as being terribly restrictive.
Mike, what does this mean, you think, when you take in what Laura's saying about the PPI, CPI, the services? How is the Fed going to be looking at that? I mean, we're going to hear from Powell today. What does he say coming out of this?
They do look at those two things because they're the major ways of looking also at CPI. And services were up 0.6 this month, and goods were up 0.4. It's a little bit of a rise for goods, which is not goods news for the Fed, to make a bad pun. But services continue to rise. They're up 2.7% over the course of the last year in the PPI. So that is an issue for the Fed. Now, whether they want to cut or not is going to depend on what happens down the road. We got CPI tomorrow. We got another CPI on the day of the next Fed meeting. They'll have more information. But while they do want to cut. They are worried about real rates and what they will do to the economy. They do want to cut, but whether they feel they can under these circumstances is an interesting question. And I guess here's a good question for figuring out whether the Fed wants to cut and whether 50 basis points will make a difference. So suppose they cut twice 50 basis points. What does that do to house prices? House prices, the housing industry just sort of stopped,
right.
But prices went up because there's nothing on the market. So will prices go up or will prices go down? That's something the Fed has to try to figure out, and there's no good rule to do that.
Especially at a time where some people are saying that on the margins, high rates have actually been inflationary when it comes to things like housing. Laura, you're going to be sticking with us right now. We do want to get a sense of what's going on elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. President Biden has announced sweeping tariffs on Chinese chips, minerals, and EVs, affecting about $18 billion in imports. It is the most comprehensive update to tariffs on China, first imposed by former President Donald Trump. The changes are set to take effect anywhere between 2024 and 25. Biden will make a formal announcement at the White House later today. OpenAI has launched a faster and cheaper version of its AI model. The new, more conversational version gives users free features that had previously been limited to those with a paid subscription, like the ability to search the web, speak to the chatbot, and hear responses in various voices. During OpenAI's presentation yesterday, the chatbot appeared to translate speech from one language to another almost instantaneously and sang part of a story upon request. Apple is preparing to sell its Vision Pro outside the U.S. for the first time. It'll be testing the appeal of the more than $3,000 mixed reality headset. Apple flew employees to Cupertino, California to begin training sessions. People familiar told us the overseas expansion is likely to include China, France, and Germany. And that's your brief. Lisa.
Thank you so much, Danny. Annmarie, I wonder what those training sessions are like. Put them on, enter this world, start to go like this, and see what happens?
Yeah, they look pretty wild. Also interesting that they're doubling down and Tim Cook has China for the Vision Pro.
Yeah, well, it's been a real conviction trade for them, regardless of some of the headwinds. Up next, we're going to talk about GameStop. We're going to talk about AMC. We're going to talk about the return of the meme stock.
There's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
That maybe things aren't as they seem. That's coming up next with Roaring Kidding. No, he's not joining, but we're going to be speaking about that coming up next. This is Bloomberg Surveillance. There was drama for a minute and then it went away. We did get that PPI data and just we saw a headline number that came in hotter than expected. Then you take a closer look at the numbers and it isn't as much higher as much as you expected. So a lot of those moves fade. Still a more negative tilt to the S&P futures this morning, a more positive tilt to the dollar stronger. The euro now actually reclaiming some of that. Yields just marginally higher, basically everything retracing to near where it was before. Under surveillance this morning, what else is happening elsewhere, which is the return of the meme stock.
What I worry about it is that it gives investors the perception that all of this is manipulated or none of it is real. And the reality is when you look at the broad market, corporate earnings have been moving up as well with the market. So there's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
Here's the latest. Meme stocks, GameStop and AMC are soaring once again thanks to the return of trader Keith Gill, or Roaring Kitty. He is not a cat, however. The stocks remain far below their 2021 highs despite seeing moves of more than 100% in pre-market trading. All it took was a tweet of a rough drawing of a man leaning forward, and it was back to the races. Gina Martin-Adams of Bloomberg Intelligence joining us now, fresh off a trip from Asia, not thinking she was going to be talking about meme stocks, and yet here we are. Even with everything else, with the inflation data, with everything else, we got to start there. Yes. Is there some signal here in terms of the mood in markets and the appetite for risk taking?
Well, we never want to read too much into a tweet driving meme stocks, but nonetheless, I do think it's a small part of a bigger picture, and that is some degree of risk tolerance revival that has started to emerge in small caps. This started to emerge 6 months ago. We saw small caps break out of a really consistent range trade that really captured small caps in a bear market, the second longest bear market in small cap history, in fact. And they started to break out a little bit over the course of the last 6 months. We're seeing in fits and starts, small caps start to perform better in general. This also accompanies some IPO activity. Remember, last year was the worst year for IPOs, even worse than in the great financial crisis. We started to see some recovery in IPO activity, and we're starting to see a little bit of recovery generally in risk tolerance. And I think that this is part of that story.
So if we can talk about meme stocks aside, and Roaring Kitty, if you haven't watched Dumb Money, great movie, by the way. I am curious, though, about how much that's really just faith in the disinflation trade at a time where the data that we've seen just now shows, albeit maybe not as much of an upside surprise, but as Laura Rame, who's still with us, pointed out, disinflation has kind of stalled.
Yeah, well, I think it's part of it. But remember, disinflation really didn't help small caps a whole lot. Disinflation really started in the very beginning of 2023. It helped select names inside the S&P 500, but it wasn't until late last year when inflation had already started to stall that small caps really started to break out. So I think this is an important clarification of trend is small caps have been in their own cycle, really trapped by an earnings recession that really held back risk tolerance there. Now that earnings recession is starting to improve a little bit. We're starting to see a little bit of recovery in the fundamentals. Yes, the inflation story is part of that, but it's not the overwhelming story. You are seeing generally better activity affect small cap earnings growth. And small caps really trade on revenue, so this is not necessarily all about inflation.
So we've just written a lot about small caps recently, and the fact that you've really had a much broader sort of 20-year trend of deterioration in quality in small caps, and a lot of this is due to companies staying private much longer. How much do you feel that small caps are really reflecting what's going on in sort of the broader markets and the broader economy?
Yeah.
I look at sort of this giant now private middle market, private equity, private debt opportunity. And the Russell 2000 seems increasingly dominated by sort of venture capital backed IPOs, sort of moonshot tech companies. There's opportunity if you get it right, but overall fundamentals aren't great.
Yeah, I would agree. And the sort of lack of IPOs has been the biggest reason why small caps have struggled relative to large caps. Not to mention the large cap companies, especially in the tech space, own all of the private sector or own the biggest companies in the private sector, which prevents them from IPOing in the small cap space. But we are seeing IPOs recover to some degree this year. And even though it's de minimis, it's better than nothing, which is what we had in 2023. And I think that that's helping risk tolerance. The other thing to consider about small caps is it's a whole lot of healthcare. And healthcare just went through a massive turmoil reflecting the pandemic conditions. Big upswing, big downswing. Healthcare could recover this year. That's a completely independent space relative to tech, not owned by big cap tech, could fuel some degree of optimism in small caps that we really haven't had for a very long time. The other thing to consider is just the leverage in financials. Remember, last year we had bank failures. This was a huge drag on small caps in 2023 that presumably starts to go away in 2024, somewhat dependent upon what the Fed does, of course.
Yeah.
We'll see where they head. But there are some moving parts in small caps that would suggest we're due for at least a little bit of recovery in this space. And we're starting to see it emerge. It is not by any stretch of the imagination robust or pervasive. It's in fits and starts. But it is a very different climate than we've been in for the last 2 years for small caps.
Does that say to you then, if you look at small caps, that we're sufficiently restrictive in this market?
Yeah, it's a really, really tough space because there's not a lot of options, right? There's no IPOs, there's no new supply. The small caps thrive in an amount of supply. They love supply. They love new options, new growth. There has been none. So it's very difficult to find your investment strategy in this space. You need the growth, you need the new supply of growth, and we haven't had it. So we need to see that to some degree. If we can't get it, it's really difficult for small caps to perform well.
Just taking a step back right now, it seems like we're trying to play around with a couple different narratives today. We're trying to understand what fiscal policy and tariffs really have to do with some of the investment themes. We're trying to understand where we are in the cycle.
Yeah.
And it's kind of head spinning. And I get the sense a lot of people have checked out from all of it and are just saying, look, I like these companies.
Yeah.
They do this well. And you know what? It's nice to keep an eye on all of that.
Yeah.
But it's getting so noisy, I can't even listen. How much is that really what you're hearing when you travel around and talk to clients?
It's pervasive. There's this underlying tone of stress related to the macro forecast. Over the last 2 years, the macro forecast has told us only to expect worse and worse and worse. And yet we had an entire cycle play out in the earnings environment. So it has taught us the hard way as investors what really drives stocks is earning trends. You have to pay attention to the earnings cycle, which is not always driven by the macro cycle and is not always easily forecasted by the macroeconomic forecast. And so I do think that this is becoming a very consistent topic. One thing that we noticed coming into both 2023 and 2024 is what was priced in the equity market, according to our models, was much closer to a macro forecast than it was to the bottom-up consensus. This year, over the past 4 months, we've started to see the market increasingly move toward the bottom-up consensus as its guidepost. It's not there yet. As our best guess is the market is priced for about 6% earnings growth, where the consensus is telling us 13%. But the macroeconomic forecast is still implying less than 2% earnings growth. So the macro's gotten it wrong. Effectively, the macro's missed an entire earnings cycle, and that's getting reflected in investor expectations. You cannot overly rely on macro forecasts to drive your investment strategy. We learned that the hard way in the last 2 years. You have to pay attention to those individual company dynamics.
And sometimes to roaring kitty. Gina Martin-Adams, thank you so much for being with us. Laura Rame of FS Investments. Final thoughts as you assess PPI and as you assess some of the sort of motley slew of narratives.
Yeah, I continue to really think that the big focus is tomorrow. The CPI data, I think, are going to show this continued trend that disinflation has stalled. And I think from here, it's so critical to recognize, and this speaks directly to what Gina was just saying, that today, expectations around the economy are very positive. I would almost argue that it's optimism at full throttle. And that is a time when we just need to recognize that probably all of the good news on the macro side is priced in. It doesn't mean that we may be in for some huge stumble, but I do think it is a time for caution because everything is so stretched.
Which means go into GameStop. No, that was not a recommendation, but that seems to be what some people are doing. Laura Rame of FS Investments, thank you so much. Coming up at 3 p.m. Eastern on the close, U.S. Trade Representative Katherine Tai, at a time where there's quite a bit of strain given the fact that announcement of highly expected tariffs on Chinese electric vehicles was announced. Tomorrow we have Evan Brown of UBS, Ed Yardeni of Yardeni Research, as well as Tom Porcelli of PGIM.